Okay. Good morning, everyone. Welcome to Byju's Exam Prep IAS. Am I audible? This is Sham Kagudia. If I'm audible, please let me know. Give me a thumbs up so that we can start the discussion. Okay. Thanks a lot. Let's start. So yesterday we started with the concept of banking. Okay, idea for banking. Very, very important. I believe I've told this 2 times already yesterday. That is in the evening session. Again, third time I'll repeat it. Banking sector is very important for you. A lot of questions are asked from the concept of banking, specifically surrounding Reserve Bank of India, the UPSC preliminary examination or civil services preliminary examination. Done. So with that caveat, what we have discussed yesterday, we started with the banking. We discussed the types of money. I believe you remember, or you have revised the concept of money. Money is basically a medium of exchange. Anything that we use for medium of exchange, that is to conduct transaction, it is called as a money. Earlier we started with the barter system, then we shifted to the commodity money, then we have shifted to the fiat money. But apart from fiat money, there is also fiduciary money and commercial bank money. After that, we looked at the banking structure in India. At the top of it, we have Reserve Bank of India, and the Reserve Bank of India regulates the whole banking structure. Right? For example, we have the commercial banks. What are commercial banks? Those come under the regulation of Banking Regulation Act, which are regulated under the provisions of Banking Regulation Act 1949, are called as the commercial banks. Now, these commercial banks are divided into two parts, that is basically scheduled and non-scheduled. Scheduled simply means those which are registered under Schedule 2 of RBI Act. They can borrow from RBI, that facility is available. Non-scheduled, I've given a list there yesterday, around 10 banks are there. Again, only 10 banks of non-scheduled? Absolutely no. There are many, many more. But for UPSC, don't by heart the list, not at all required. So non-scheduled simply means those which are not scheduled under Schedule 2 of, or those which are not registered under Schedule 2 of RBI Act of 1934. Then we started with the Reserve Bank of India. Reserve Bank of India basically was established on 1st April 1935. The government of India set up a commission, and that commission recommended that we should have Reserve Bank of India, a central bank. And that is the reason they passed an RBI Act of 1934. And as a result of this, we established RBI. Initially, it was privately owned, that is, private investors were there. After independence, 1949, it was nationalized. Initially, 1935, it started functioning from Calcutta. 1937, it was shifted to Bombay or Mumbai, and it from that point of time, it is still there in Mumbai itself. Now, apart from this, what is the constitution, or let's say composition of Reserve Bank of India? Composition is very simple. You will see the most important authority within Reserve Bank of India is the Central Board of Directors. The Central Board of Directors has a composition of 21. It is headed by the Governor of Reserve Bank of India, who is appointed by Government of India. Right? Then there is the regional offices. Then there are 4 offices in metro cities. Apart from that, we started with the functioning or the functions of RBI. The first very important function of RBI is to control inflation, that we have discussed last week under the concept of inflation. That is Government of India signing an agreement with RBI. Hence, RBI is given the duty of controlling inflation at 4%. That is CPI, headline inflation. Right. Then there is another function of RBI, that is acting as banker to government. And that is where we were discussing. We'll continue from that slide itself. I hope remember yesterday we have discussed this. That is Government of India, whenever they announce a budget, generally we see that the expenses are greater than the incomes. Now, because there is a shortfall, because there is a gap like this, government borrows from the market. Now, the borrowing could be internal in nature, borrowing could be external in nature. And I used the term yesterday, I hope remember that, the term of debt. Whenever government borrows, we will simply say it has to repay. That repayment obligation is nothing but the concept of debt itself. Now, government can borrow from the external market. We'll call this as external debt. Government can borrow from internal market. We'll call this as internal debt. Most of the debt that the government of India has is basically internal in nature. In fact, yesterday in the evening, at the fag end of the discussion, I gave you certain data. As per the latest economic survey, 4.9% of the debt of the government is external in nature. More than 95%, that is 95.1% of the debt is internal in nature. And I told you, because most of the debt is internal, it is considered to be a good feature for a country. For a very simple reason, internal debt is generally repaid in the form of domestic currency. Whereas external debt, you need to have, let's say, the foreign currencies, that is the dollars, to make a payment. And you cannot print dollars. Then you'll have to be dependent on IMF. I hope you are reading the newspapers. Then you'll have to be dependent on IMF. For example, Sri Lanka is dependent on IMF and other countries. Pakistan is dependent on IMF and other countries. Why? They have a huge amount of debt to repay, but they do not have dollars. And if you do not have dollars, you cannot print dollars, right? You will have to borrow from someone like this, right? So that is the reason having large amount of a debt which is domestic in nature is always considered stable or preferable. Okay, then internal borrowing. How does the government do internal borrowing? I gave you the most important form of or substantial amount of internal borrowing that the government does is by issuing government securities. Securities are nothing but instruments. I hope you understand. Government issues the securities. These are nothing but instruments which can be traded in the market. For example, right, today we'll be using this particular piece of paper a lot. Please do let me know, can you see this particular piece of paper right in front of me? Can you see this particular piece of paper? What I've written on the piece of paper? 100 rupees, 3 years and 8%. Now, simple question to you, right? Can government issue this kind of a piece of paper? That is called as a bond. I hope you understand. Can government issue this piece of paper in the market? It's a security. Can they issue it? Of course, yes. That is called as a government bond. And yesterday, I hope you remember this, we have discussed this. Whenever government issues securities in the market, they can be of two types. One, which will have a shorter maturity, that is up to 1 year. These are treasury bills, T-bills or treasury bills. And the second, which will have a longer maturity, more than 1 year. These are called as dated security. Now tell me, the one that I'm holding in my hand, is it a treasury bill or a dated security? The one that I'm holding in my hand, is it a treasury bill or a dated security? All of you will agree it is a dated security. Anybody who says it's a treasury bill, sir? Because the time period, that is a maturity period, is given here, right? 3 years maturity period is given. So it's a dated security or government bond. Why do we call it as a government bond? Simple. Whenever you use the term bond, remember this, the maturity period is more than 1 year. Right, sir? What if the maturity period is less than 1 year? We'll simply call this as treasury bill. Now, similarly, dated securities, they can be issued even by the state government. But in the context of state government, we'll simply call this as state development loans. SDL, state development loans. This is where we stopped yesterday, the discussion. Let me pick it up from there. Let's continue. Now, first and foremost, please understand this carefully. Understand the process very carefully. Here is Reserve Bank of India and here is the Government of India. Government of India, imagine they want to issue this particular bond in the market and they want to borrow 100 rupees from the market. Government doesn't directly go to the market and start selling. What do you mean by market? Right, there is a bond market where bonds, that is these types of instruments, are purchased, are sold, etc., etc. So understand the process here. Government, imagine, right, again, I know I'm not the government, but imagine I'm the government. I want to sell this 100 rupee and I want to collect 100 rupee from the market. I will not directly sell it. You are RBI governor. I will simply hand over this particular bond to you. Now what you will do? You will sell this, rather than using the term sell, right terminology will be, you will auction this bond in the market. The buyers or investors will purchase this particular bond and you will collect the money and transfer to the government. Is the process okay here? It's a very simple process. Do not complicate it. What I'm saying is government wants to sell the government securities because they want money. Simple. Now what RBI does? RBI will conduct auction. Auction basically is a sales. RBI will conduct auction. It will sell the bonds in the market. It will collect the money, transfer to Government of India. This is how RBI will arrange the loans. This is how RBI will arrange finances for the Government of India through market borrowings. Now this is very important. Why? Follow this carefully. Later when we start discussing regarding RBI, right, that is how can RBI control money supply in the market, I will generally say that one way that RBI can reduce or increase the money supply in the market is by selling or buying the government bonds. I'll repeat the statement. One of the ways that RBI can increase or decrease the money supply in the market is by buying or selling government bonds. What do I mean by this? Let's take a very simple example. Imagine you're RBI governor. I am a common man. I'm a financial institution, I'm a bank, or I'm an individual. Imagine there is a lot of money supply in the market. Now, is it okay if I say, if the money supply is very high in the market, that can cause inflation? Anybody disagrees? Please do let me know. If the money supply is very high in the market, that can cause inflation. Now, as an RBI governor, what can you do in this context? How can you reduce the money supply? What you will do is, you will sell me this bond. I hope you understand. You will sell me this bond. I will give money to you, thereby reducing the money supply in the market. Now, on the other hand, you want to increase the money supply. Sir, why would I want to increase the money supply? Because you want to promote growth. Money supply increases, interest rates automatically will come down. All of you will agree with me? Just remember a common theme here. Money supply increases, interest rate will come down in the economy or not? Anybody disagrees? Anybody has a doubt? Please do let me know. It's basically the concept of supply and demand. If supply increases, obviously the interest rate has to come down. If supply decreases, interest rate has to go up. Remember this. It's very easy. Remember this. Now you want to promote growth. How can you promote growth? Increase money supply so that the interest rate will come down. If the interest rate will come down, automatically the loans issued will be at a cheaper rate of interest. People will borrow more, consume. Companies will borrow more, invest, which is good for the economy. Now, how can you increase money supply? Simple. Imagine I have 100 rupees. Okay, I'm a bank, I'm an individual, etc. I'm having this particular bond. You will give me 100 rupees. You will purchase the bond, thereby ensuring money supply in the economy has increased. Done. Thereby ensuring that money supply in the economy has increased. So understand this very carefully. Whenever Government of India wants to sell bonds in the market, RBI doesn't directly purchase the bonds from the government. Please remember this. I'll repeat it again so that it is basically tattooed in your mind. When Government of India issues bonds in the market, RBI does not directly purchase the bonds from Government of India. That is not allowed. Why it is not allowed? Earlier it was done. Right? Understand this. Earlier it was done. But the problem with this system is, if Government of India issues a bond, directly RBI purchases the bond. Don't you think the money supply in the economy will automatically rise up? Is it okay? Right? I hope you understand this. If Government of India issues a bond and RBI purchases the bond, RBI will give money to Government of India. Don't you think that directly will increase the money supply in the economy? This 100 rupee, imagine this, I'm Government of India, you are RBI, you have printed 100 rupee. You are not involved in transactions in the market. You are not using that 100 rupee, it is there with you. It is not getting circulated. Now what I'll do, I will simply give you this 100 rupee bond, you will give me 100 rupee, which means the 100 rupee which was not there in the circulation now has entered into circulation. Will it not increase money supply? Yes. Can it cause inflation? Answer is again yes. But some of you will say, sir, that can happen in the economy as well. My dear, understand the difference. RBI prints money. You do not print money. I hope you understand this. RBI prints money. You do not have the right to print money. So whatever money is already there in circulation, that can either be infused back or taken away by issuing or by purchasing the bonds. But if Government of India issues a bond, directly RBI purchases, that will lead to increased money supply, can contribute to inflation. We have discontinued it. We have basically discontinued it. There is a technical term here, understand this. Earlier, Government of India used to issue bonds, I'll directly write it, sell bonds or government securities to Reserve Bank of India. And is it okay if I say, when RBI does this, it will provide money to the Government of India, increases money or increases money supply, government can get money to spend. In the budget, government will get the money to spend for various expenditures. This was referred to as direct monetization. This process is referred to as direct monetization. Any difficulty, please do let me know. This process is referred to as direct monetization. Do we have a direct monetization today? No, we do not have a direct monetization. We have discontinued it. Why? You already know the reason. This is called as indirect monetization. What I've explained above is referred to as indirect monetization, where RBI does not directly purchase from Government of India. It will auction or sell the government securities in the market, collect the money, transfer to the government. So this is referred to as indirect monetization. This is referred to as direct monetization. We do not have direct monetization. We have indirect monetization. Any difficulty in understanding this, please do let me know now. Because this should be very clear to you. Because very often in the newspapers, you'll come across the statement, RBI has sold bonds. RBI has purchased bonds. And whenever they say RBI purchased bonds, it doesn't mean RBI is purchasing from Government of India. No, right? Only from the market. Is it okay? Right. So that is the basic concept of direct and indirect monetization. Okay. Why indirect? My dear, basically, what I've explained, you're asking it again. Why indirect? I told you, if you go for direct monetization, that will lead to inflation in the market. Okay, that will basically lead to inflation, right? Basically, it will cause a lot of inflation in the market because the money supply increases. Okay, so this is a basic idea. This is a basic idea why RBI plays a very important role in helping Government of India to borrow from the market. Now, let me go ahead. There is a certain very important concept that is very often cited in the newspaper, not used anymore, but 2 years ago it was actually used by RBI. Of course, I'm talking about the concept of, I'll go back to previous slide, don't worry. I'm talking about the concept of Operation Twist. Very often you must have come across the term Operation Twist in the newspaper. Let's try and understand what is this idea of Operation Twist. But before that, whenever Government of India issues these securities, these are also referred to as gilt securities or gilt-edged securities. Gilt-edged securities. Right? That is one more name for this. Government securities are also referred to as gilt-edged securities. Now, don't say, sir, gilt spelling is wrong. No, it is actually this spelling itself. G-I-L-T, gilt-edged securities. Now, why these are referred as gilt-edged securities? UPSC will not ask you this, but just a point of information. Just a point of information. You must have seen certain types of securities which will have in the edges, they will have certain color codes. Is it okay? Right? Even if you have not seen, don't worry. Can you imagine this? Right? This is a government security where in the corner, they will basically have certain colors like this. Earlier, government securities used to have colors in the corner. And because they used to have colors, these were referred to as gilt-edged securities. That is, at the edges, you will have colors. I hope it is clear why these are called as gilt-edged securities now. So government securities are also referred to as gilt-edged securities. Please don't be confused when they use this kind of a term. Now, second very important point here, because these are issued by the government, these have a very, very high safety. Is it okay? Because these are issued by the government. Because understand this carefully, bonds can be issued by the government as well as corporate sector. A company can issue bond, it is allowed. Best example in the current affairs, Adani bonds. I'm pretty sure you're reading the newspapers, Adani bonds. Government is also allowed to issue bonds. Private sector is also allowed to issue bonds. But simple question to you, imagine private sector company A has issued a bond, government also has issued a bond. In which of the two types of borrowers do you think you have a highest safety of your investment? Just think of it, it's very simple. Right? You are basically investing with a company also, you are investing with government also. That's your investment, by the way. With which of the two do you think you have a very high safety of your investment? Obviously government. Obviously government. So government borrowings, whenever they issue securities in the market, they have very, very high safety. Right? Very high safety can be attributed to government bonds, government securities in the market. These are certain very important points. Now, let me start the discussion. Right? Certain basics first. First and foremost, yesterday also we have discussed this. Bonds are nothing but debt instruments. Is the definition clear to you? Bonds are nothing but these are debt instruments. In fact, yesterday in the evening also we have discussed this. Bonds are used for borrowing purposes in the market. And when you borrow, it simply means you have a debt. Hence, we simply say bonds are nothing but debt instruments which can be used by the borrower to issue and borrow from the market. Now, the bonds can be issued by the government as well as by the private sector as well. Once the bonds are issued, please remember this. Once the bonds are issued, generally, at least the traditional concept is that the bonds will carry certain rate of interest. Please have a look at the piece of paper. Can you see the rate of interest? Right? Can you see the rate of interest in the bottom part of the paper here? What is the rate of interest cited or given on the piece of paper? 8%. Right? The rate of interest given on the piece of paper is 8%. Meaning is very simple. Imagine here is the government. Government will give you, right, this particular bond, collect 100 rupees from you, and annually they will give you 8% rate of interest. Now understand this next point carefully. Whenever you talk about the bonds like this, the 8% of what? I hope you understand. Right? What is this 8%? 8% rate of interest. 8% of what? 8% of whatever is the value given here. What is the value given here? 100 rupees. And remember this 100 rupees called as a face value. Let me know if you're finding these terms difficult. These are very easy. What is given on the bond? 100 rupee. I will call this as a face value. Let me show you an example. Have a look at this. Just have a look at this. What is the face value of this bond? What is the face value of this bond? Rupees 100. What is the value of this bond? Rupees 110 only. What is the face value of this bond? 10 rupees only. Right? Is the logic of face value okay with you? Let me know, because I'll go to the next point. You should be very clear with all of this. Is the value of, or is the concept of face value clear with you? Whatever is written on the bond, it is called as face value. Point one. Second, this rate of interest in the context of bonds, rather than using the term rate of interest, we use the term coupon rate. Second point I'm going. Rather than using the term rate of interest, in bonds, we use the term coupon rate. So what is the coupon rate for this bond? Coupon rate is 8%. And this coupon rate, or basically rate of interest, is calculated on what? It is always calculated on the face value of the bond. Which means if you purchase this bond, government annually will give you 8 rupees. I repeat, if you purchase this bond, government annually will give you 8 rupees. Now next point is very important. Follow this very carefully. You will purchase it. You can sell the bond to someone else. This is where the complexity will start. Follow the discussion carefully. You will purchase the bond from the government. You will sell the bond to someone else. Or you already have one bond. You can purchase one more bond from someone else in the market. Why? Bonds are simply tradable. Tradable means you can purchase or you can sell the bond. Now, simple question to you people. Simple question. Don't complicate everything. Simple question. The value of the bond, let's say, is 100. You have purchased it because the value is written on the page like this. Now, is it okay if I say, when you will sell this bond to the market or you will sell the bond to someone else in the market, you could either sell it at 100, you could either sell it at more than 100 or less than 100 rupee. This is where you will have to be very careful. I'll repeat it. You will purchase the bond from the government. Value is 100. Face value is 100. Now, is it okay if I say you can sell this bond whose face value is 100 either at 100 rupees, more than 100, less than 100? Is the logic okay with you or not? Please do let me know. Again, either you can sell it at more than 100, less than 100 or even 100 rupee. Now, some of you are asking, how sir? If the value of the bond face value is 100, how it is possible that I will sell it at more than 100? I'll give a very simple example. Simple example. Imagine you paid 100 rupee, bought the bottle. Right? You bought the bottle. You want to sell it in the market. What if the demand for the bottle is very high? You tell me the answer. If the demand for the bottle is very high, will you sell it at 100 or more than 100? Just think of it. If the demand for the bottle is very, very high, will you sell it at 100 rupee or you want to make more profit, you will sell it at more than 100? Obviously, you will sell it at more than 100. I'll give you a second example. Right? Have a look at this. You bought a bottle. In the market, everybody is selling the bottle. Everybody. A lot of sellers are there along with you, which means supply is very high. Supply is very, very high. You tell me, will you sell the bottle at 100 or less than 100 now? Now, I hope you understand the logic here. I hope you understand the logic. But bottle is not bond. My dear, replace the bottle with bond. You want to sell the bond. Along with you, there are many other sellers in the bond. Right? There are many other investors who want to sell this particular bond, which means supply is very high. You tell me, why should I pay 100 rupees to you? Just think of it. Basically, supply and demand. It's always supply and demand. Right? You are saying, sir, it is bottle, but this is a bond. Say very simple argument. You want to sell the bond, but there are many other sellers also in the bond, sellers also of the bond in the market. Why should I purchase it from you only? Simple question. Why should I purchase it from you? I can purchase it from someone also, right? Why from you? I will purchase it from you because the value of the bond is 100. You're willing to sell it at 95 rupees. That's the reason I will buy it from you. I hope you understand this. It's always supply and demand. Very simple, supply and demand. Do not complicate it. Again, I repeat, do not complicate it. Basic logic is, if supply increases, market price of the bond should fall down. That makes perfect economic sense. And if the demand increases, the market price of the bond should go up. Right? This is clear. Shall I go to the next one? Can I go to the next one? Now, some of you are asking, sir, why the demand will go up or why the supply will go up? Let me ask you a very simple question. Imagine there is a recession that is going to happen in the Indian market and you want to invest in the market. Where do you want to invest? You want to invest in the shares of, let's say, Adani group of companies, or you want to invest in the shares of, let's say, Zomato, or the worst case scenario, you want to invest in the shares of Paytm, or there is a government bond, you want to invest in the government bond. You tell me. Simple logic. If there is uncertainty, volatility, slowdown or recession that is taking place in the economy, where you want to invest your money? You want to invest in private sector bonds. That's very dangerous, my dear. Which has highest safety? Just go to the basics. Which has highest safety? Government bonds. Now, is it okay if I say, in that situation, the demand for government bonds will automatically rise up? All of you will agree with me? Right? In that situation, the demand for government bonds will automatically rise up. One of you says, sir, I will invest in Infosys. My dear, be very careful. Infosys is also under pressure now. If you're reading newspapers, you will know that. In the last 2 weeks, they have removed more than 6,000 people. More than 6,000 people. That's not a very good indicator. But again, it doesn't mean that they are incurring losses. I'm saying their financials are under pressure. But again, don't worry. Right? So argument is simple. Government bonds are very, very safe. So what will happen? The demand for government bonds automatically goes up. Is it okay if the demand goes up, market prices automatically will go up? Now I'll give you one more example. Now the market starts thriving. Market starts performing very well. Right? You can invest in any private sector company. They are registering very high profits. Your market price of the shares are going to increase, etc., etc. Now, don't you think in order to earn higher returns, in order to earn a better income, you will move your investments from the bond market to stock market? Just basic application. Because you want to earn higher profit. Very simple. If the market prices of, let's say, Tata shares are going to increase, they are going to perform better. If, let's say, Infosys share price is going to increase, Adani's share prices are going to increase, why will you invest in government bonds? Earn 8%. Why 8%? You will purchase a share of Adani group of companies, let's say at 200 rupees. You will sell it at 220 rupees, thereby making a profit of 20 rupees. So the logic is the demand for the government bonds might vary. Supply of the government bonds might also vary. And when the demand and supply changes, the market price of the government bonds will also change. Any disagreement, please do let me know now. So the demand and supply will change. When the demand and supply will change, automatically the market prices will change. That is basic application of economics. Now come to the next point. Imagine a bond is there. The face value of the bond is 100 rupees and the coupon rate is 8%, like I'm showing here. Annually, how much interest you are going to earn? Annually, you will earn 8 rupees. All of you will agree? Annually, you will earn how much? 8 rupees. 8 rupees. Please understand this carefully. But please understand the next point also. Your returns in this case, your returns, how much returns you are earning in this case is 8%. That is 8 divided by 100. Now, simple question to you people. What if you are earning 8 rupees, but your investment is 95 rupees? Tell me now. Just think of this very carefully. What if I say you are going to earn 8 rupees, but your investment is 95 rupees? Don't you think the percentage of returns you are going to earn will be more than 8%? Is it okay? I'm talking about percentages now. You will earn interest of 8 rupees, no doubt. But your investment is 95 rupees. You are investing 95, but you are earning 8 rupees. Don't you think your returns would be more than 8%? Your returns would be more than 8%. And on the other hand, imagine you are investing 102 rupees. On the other hand, you are investing 102 rupees. And you will earn 8 rupees. What is your percentage returns? Your percentage returns will be less than 8%. Again, you don't have to be an expert in doing this. Use calculator. 8 divided by 102, right? And 8 divided by 95. You will get, in the first case, returns is less than 8%, I'm talking about this. In the second case, you will get returns which is more than 8%. So far so good? Any doubts? So far so good. But how? My dear, again, follow the basics here. Follow the basics. If you remember, I told you, if government has issued this in the market, government has told you how much? 8% returns they will give you. 8% of how much? 8% of face value. Face value is 100. So whether you are owning this bond or I am owning this bond or you will sell it to someone else, doesn't matter. Government will always calculate 8% of 100 rupees only. They'll always calculate 8% of 100, give 8 rupees to anybody who is owning the bond. Now the issue is that you might own the bond today. They will give you 8 rupees. You will sell it to, let's say, your friend, but you could sell it at 95 rupees. Possible? You could sell it at 95 rupees. In that case, what will be his returns in percentages? Is it okay? What will be his returns in percentages? It will be more than 8%. Agreed. Or second situation, you will sell it to your friend at more than 100 rupees, let's say 102 rupees. He is going to get 8 rupees. But what is his investment in the bond? 102 rupees. So what is his percentage returns? Percentage returns will be less than 8%. Any difficulty here? Any difficulty? Right? Now if you have understood this concept of yield, coupon, everything becomes very clear to you. Now whenever you talk about percentage returns, you are talking about yield rate. Understand this. Whenever you are talking about percentage returns, you are talking about yield rate. Now look at this very carefully and just think of this and answer to me. Is it okay if I say, if the market price of the bond goes up, yield rate will come down? The numbers are there right in front of you. Please have a look at it. I'll repeat it. Is it okay if I say that if the market price of the bond goes up, yield rate will come down? And on the other hand, if the market price of the bond goes down, yield rate will go up. Any difficulty? Any difficulty? But 8% of 102 is more than 8% out of 100. My dear, if you are going to invest 102 and you are going to earn 8 rupees, what is your return on the investment? If this is how you are going to calculate investment, please don't invest anywhere. You do not know how to calculate your returns. Forget about 100. 100 is useful for what? Government to calculate coupon amount and give to you. But did you purchase this bond from your friend, let's say, at 100 rupee? Did you purchase it at 100? No. You purchased it at 102 rupees. You could have purchased it at 95 rupees, 97 rupees, etc., etc. So in the market, the prices will vary. I hope you understand. In the market, the prices will vary because of supply and demand. But imagine, let me show it. Let me give you one more example here. Imagine you invested 95 rupees and purchased a bond, and you are going to get, let's say, 9 rupees a coupon on it. Now, don't you think, rather than purchasing it at 95, if you had purchased 90 rupees, if you had paid 90 rupees and purchased it, your yield rate could have been much, much higher. I hope you understand. Rather than paying 90 rupees or let's say 95 rupees and purchasing a bond, on which bond you are going to get 9 rupees, if you had paid 90 rupees to purchase it, don't you think your yield rate could have been much, much higher? Right? That is the logic here. So again, the concept is simple. Do not complicate it. The 100 rupees only useful for calculation of interest. That's it. Forget about it. In the market, the price will vary. Price could go up, price could go down. Why? Because of supply and demand. But when the supply increases, the market prices will go down. And it should make very, very important, understand this. It should make perfect economic sense to you. Let me explain it. At least understand it this way. Imagine government says, I will give you 8 rupees. Simple. Understand this carefully. 8% of 100, government says, I will give you 8 rupees. Fixed. I will not change it. Now imagine everybody wants to sell to you. You're the buyer in the market. Everybody wants to sell to you. Is it okay if I say, if everybody is wanting to sell to you, it simply means supply is higher in the market. Just a second, I'll add one more slide here. Is it okay if I say, if everybody wants to sell to you, supply of the bond is very, very high in the market. Agreed? Next point. Now government says, I will give you 8 rupees. That's it. I will give you 8 rupees. So you know that whatever amount you pay, you will get 8 rupees on this bond. Now just think of this. You will get 8 rupees that is fixed. You can't change it. Because generally what would happen? You would want more returns. You will demand 9 rupees, 10 rupees, etc. But does government change it? No, government says 8 rupee fixed. So what you will do now? Rather than purchasing it at 100, you will basically say, if everybody wants to sell to me, I will purchase it at 99. I will purchase it at 98. I will purchase it at, let's say, 97, so that my investment goes down and percentage returns will automatically go up. Does it make sense or not? Please do let me know. Because it is fixed that you get 8 rupees. It is fixed. But there are many sellers who want to sell to you. Will you purchase it at 100 rupees? If you do that, please don't invest in the market. You do not know how to operate the market then. You should basically say, why should I purchase it from you? Rather than the other buyer, other seller, why should I buy it from you? I will not purchase it. You give me at lower price. Right? Otherwise, let me give you the basic example. Have you been to market to purchase onion? Just think of it. Have you been to market to purchase onion? Imagine there are two sellers who are sitting side by side. If one person says 30 rupees per kg, don't you want to purchase from the second seller at a price lesser than 30 rupees per kg? Does it make sense or not? If some of you say, no sir, I will not do that, I will purchase it at more than 30 rupees per kg, please don't go to market then. Right? Please do not go to market. Right? Basically, you do not know how to purchase the goods in the market then. So this is exactly what will happen. Now finally, I have to understand this. Finally, is it okay if I write this relation? Let me know. Finally, is it okay if I write this particular relation? The market prices of the bonds will vary, that is either increase or decrease, and the market prices are inversely related to yield rates. Please do let me know. I am only concerned about this. The market prices are inversely means what? Opposite direction. That is, if the market prices will go up, yield rate will go down. If the market prices of the bonds will go down, yield rate will go up. Is this relation okay with you people? You will have to remember this. In fact, a question has been asked on this in the preliminary examination. In the preliminary examination, the question has been asked. Now, please be very careful with this relation. Can be used again and again in the newspaper, in the UPSC preliminary examination, as well as to understand the current affairs. Now, bonds are tradable in the market. These can be bought and sold. And bonds, the yield rate will change because the market prices will change. That is one very important point. Please remember this. Now, some of you will simply say, sir, right, you have skipped a slide. I've covered this. Right, what I've given here is basically the same thing that I've discussed. Here is an investor, government or private sector company will sell the bond, collect the money, and after the maturity period is over, government will return the money and recollect the bond. Right? It's a basic step-by-step process that I've given here. Now, finally, before I enter into operation twist, one more very important concept here. There is a tool used by RBI called as open market operations. I've discussed it. Let me put it in a statement now. Open market operation. In short, it is called as OMO. Open market operation. In short, it is called as OMO. Now, what is this open market operation? It's basically a tool used by Reserve Bank of India either to increase or decrease the money supply in the market. Simple. It's a tool that is used by the Reserve Bank of India either to increase or decrease the money supply in the market. So what do you mean by this? Let me ask you a very simple question. We have discussed this, by the way. Tell me the answer. If RBI wants to promote growth, right, don't you think RBI will supply more money? Is it okay? RBI will supply more money in the economy. And by using bonds, how can you supply more money in the economy? Simple. RBI will buy government securities. Is it okay? RBI will buy government securities, not from Government of India. I've told this already. Not from Government of India, but from, let's say, banking sector, from institutional investors, from you and me, etc. like this. So RBI will buy government securities by increasing the market supply of money. And by selling government securities, what does RBI do? RBI will RBI will sell the government securities, thereby taking away the money from the market, reduce the money supply to control inflation. Is it okay? I'll repeat it again. Open market operation simply refers to a system used by RBI where it will either sell or purchase government securities. Right? Basically two things. Sell, purchase government securities. If they will sell, basically it will reduce money supply in the market. If they purchase, it will increase the money supply in the market. They will increase money supply to promote growth. They will basically sell to reduce money supply to control inflation. That is open market operation. Now all of these points are clear? All of these points are clear. Please do let me know. Now understand this very carefully. Let me go back to the earlier slide so that I'll write it there only. In case of indirect monetization, how does Government of India or how does RBI auction these government securities? There is a system which is used by RBI which is called as e-Kuber. Can be asked in UPSC, please remember this. There is a system. System means there is a platform, website in simple terms. There is a system that is used by RBI which is referred to as e-Kuber. The name of the website itself is e-Kuber. Right? In e-Kuber, the auctioning of government securities will be conducted, and who will purchase these government securities? Simple. Banks. Banks can purchase these government securities. Right? Can let's say insurance companies, they will purchase these securities. Mutual fund companies, pension companies, etc. There are many buyers like this who will purchase these government securities where or whenever the RBI will auction the government securities. Now that is one point. Second point, imagine you have government securities, you want to sell them. Understand the next point very carefully. Imagine you have government securities, you have purchased, right, the government securities, you want to sell them. Then there is one more website. The system name is NDSOM. Negotiated Dealing System Order Matching. Remember the names of the websites, can be asked in UPSC. Negotiated Dealing System Order Match. NDSOM. Order Match. Is it okay? Right? Any issue so far? Please do let me know. Whenever RBI will auction the G securities, the portal or the system that RBI uses is called as e-Kuber. And imagine you have purchased the government securities. Now you want to trade them. You want to sell them in the market. The system that is used is referred to as NDSOM, Negotiated Dealing System Order Match. These are the technical terms. UPSC can ask you this. Please be very careful. Please be very careful. Okay. Now let me enter into, right, basically the concept of operation twist. Idea of operation twist. Now please be very careful here. Operation twist is nothing but it's nothing but basically a system or a process used under open market operations. It's a type of open market operations. When I write OMO, is it okay what I'm writing? OMO is nothing but this, open market operation. It's nothing but a type of open market operation. Now what happens under operation twist? Very, very typical, very interesting. Follow this carefully. Under operation twist, simultaneously, please remember that, right? Simultaneously, Reserve Bank of India will sell as well as purchase government securities. I'll repeat it again. Under operation twist, right, Reserve Bank of India simultaneously will sell and repurchase. Repurchase means purchase government securities. Now, why they do that, we'll understand it. Just give me some time. Before that, let me explain one more very important point for you. Government will issue multiple types of bonds in the market. All of you will agree with this? Government will issue multiple types of bonds. Multiple types means the bonds which will have different maturities. Government will issue bonds with maturities of 2 year, 3 year, 5 year, 10 year, 30 years bonds is there, 40-year bonds are also issued by the government. But out of all of these bonds, there is one government bond which is considered as a standard, as a benchmark in the market. Remember this. In the market, there is one bond issued by the government which is considered as a benchmark. Benchmark means a reference point, a standard if you want to say. That benchmark bond of Government of India is the bond with maturity of 10 years. I'll repeat it again. Government will issue bonds with different maturities. 2 years, 3 years, 5 years, 10 years, etc., etc., etc. But out of all of these bonds, there is one bond on which the market has very, very high expectations. The market looks at this particular bond, uses as a reference point, and that is called as a benchmark. And that benchmark bond of Government of India is the 10-year government security. Now some of you will ask, sir, why do they use as a benchmark? Let me ask you a very simple question. In the whole banking sector in India, there are many banks in India. All of you will agree? Anybody has a doubt? Please check the website. There are many, many banks in India. But you tell me, out of all the banks in India, which is the benchmark bank? Benchmark means which is considered as a standard bank in India, for which plays a very, very important role in the market. Thanks a lot. Again, don't worry about RBI. RBI is not a benchmark here. It's not involved in lending. It doesn't give you loan. RBI doesn't give you loan. It's basically a regulator. All of you will agree SBI? Is it okay? All of you will agree SBI? Now if I ask you why SBI? Right? SBI, for a very simple reason, investors have a lot of confidence on the SBI. The market has a lot of confidence on SBI. In the same way, there are various types of bonds which are issued by the private sector, by the government as well. But in the market where the trading volumes are very, very high, where the expectations of the market, where something is used as a standard in the market is very high, it is nothing but a 10-year government security. Can I go to the next point? This is important. 10-year government security. Now, next point is very important. Follow this carefully. If the yield rate of the benchmark changes, if the yield rate means what? Your returns, right? For example, if you are getting, let's say, 9% yield rate on this benchmark bond, what does it mean? Right? What does it simply mean? Your returns are fetching you 9% rate of interest. Any difficulty? If the yield rate of the benchmark changes, let's say from 9% to 10%, you tell me, what do you think will happen to interest rates in the market? I'll repeat it again. Point number one, 10-year government security is a benchmark, standard. And the yield rate on the standard, that is a benchmark in the market, increases from 9% to 10%, which means your investments are earning more interest to you. what should happen to the interest rates in the market? Interest rates should increase in the market. Everybody agrees? Anybody disagrees? Please do let me know. This is technical, I know that, but this is how you simplify the process, right? Yield rate of the 10-year government security goes up, which means you are earning more interest on it. And if you are earning more interest on it, will you not demand the same type of an interest from other borrowers as well? Right? I hope it makes perfect sense to you. You are saying, right, have a look at this, just a second. Okay, what you're saying is, this is a government bond. The yield rate on this government bond increases from 9% to 10%. Imagine you have 100 rupees. Simple. Imagine you have 100 rupees, but the yield rate on this has gone up from 9% to 10%. You want to invest 100 rupees in the market. If the yield rate on this bond is 10%, will you not demand the same type of interest rate on other securities in the market? Will you demand or not? If a private sector company will come to you and say, sir, please purchase my bond, right? Private sector company, will you demand 8% rate of interest on it? Will you demand 7% rate of interest? If you do that, you are wrong. Please don't invest in the market. What you should say is, if I invest in a government bond, I'm getting 10%, right? Don't you think I should get 10% from you as well? I hope you understand this. On the other hand, yield rate on government securities, that is a 10-year government security, will fall from 9% to 7%. You tell me. Yield rate on 10 years standard government security will fall from 9% to, let's say, 7%. Right? You will ask a private sector company to give 9% coupon rate. Will they give 9% interest rate to you? They will laugh at you. They will simply say, why should I give you 9%? The benchmark is giving you 7, so I will also give you around 7. Does it make perfect sense? I hope you understand. Right? So all these are very intricate concepts, but once you understand it, done and dusted. Once you understand, it's very, very easy. Now, what are the important points? Because I'm going to start Operation Twist. What are the important points? 1, government issues multiple bonds. The market prices of the bonds will keep on changing because of supply and demand. And because the market prices are changing, the yield rate will also change, but in opposite direction. Point 1. Point 2, the government will issue multiple types of government securities, but the standard, the benchmark security in the market is a 10-year government security. And whenever the yield rate on 10-year government securities will change, the interest rates in the market will automatically change. Why? Others will follow the yield rate of 10-year government securities. Now, I'll use all of this in explaining Operation Twist. Follow it very carefully. Now, what is Operation Twist? First, under Operation Twist, which is nothing but a type of open market operation, RBI simultaneously will sell and buy government securities. I'll repeat it. Right? Operation Twist is nothing but a type of open market operation wherein RBI simultaneously will sell and buy government securities. Now, it's not over. Definition is not over. Of the same value. Simultaneously buy and sell government securities of the same value. Meaning what? If government is selling 10,000 crore worth of government securities, the RBI, if it is selling 10,000 crore worth of government securities, it will simultaneously buy 10,000 crore worth of government securities. Now, what is the meaning of it? Why they're doing? Some of you will basically say, sir, it doesn't make any sense. You will understand. Have patience. So when they sell 10,000 crore worth of government securities, you tell me, will the money supply increase? Simple. If they sell, if they sell 10,000 crore worth of government securities, will the money supply decrease? All of you will agree? They will sell 10,000 crore rupee government securities, bonds, they will take out 10,000 crore from the market. But what if RBI wants to promote growth? What if RBI wants to promote growth? Money supply will come down, interest rate will go up. Don't you think, right? That will basically hamper growth in the economy, right? So far, so good. So what RBI does is, it will simultaneously buy 10,000 crore worth of government securities. So from one hand, they will take out 10,000 crore. In the other hand, they will supply 10,000 crore rupees. You tell me, will the money supply change here? Have a look at this. And why they are doing it? Have patience, I'll tell you. On one side, they will supply 10,000 crore. And on the other hand, they will take out 10,000 crore rupees from the market. Simple question to you. Will the money supply change or not? Money supply will not change. All of you will agree? Money supply will not change. Money supply will remain same. Now, sir, why? Why are they not changing money supply if they want to promote growth? What if I were to say that there is also inflation in the economy? They want to promote growth. So if they sell 10,000 crore rupee worth of bonds, it will not promote growth, it will hinder growth. But if there is also a very high rate of inflation, they cannot simply buy government securities, because if they buy government securities, money supply will increase and that will cause inflation. But you tell me, by buying 10,000 crore worth of securities and selling 10,000 crore worth of securities, are they causing inflation? Is there any problem of inflation here? Absolutely no. They are not going to contribute to inflation. This is okay with you? This is clear with you? Why they are selling and buying equal value of government securities. Now come to technicalities. Whenever they sell, they will sell short-term government securities. And whenever they buy, they will purchase long-term government securities. This is important. Whenever they sell, they are selling simultaneously and buying. They are selling, buying, so that the money supply does not change. When they will sell short-term G securities. When they will buy, they will purchase long-term G securities. Long-term G securities, which are nothing but 10-year G securities. Why, you will understand in a minute. That is the beauty of Operation Twist. Have patience always. We are going step by step. Why they are simultaneously selling and buying equal value? So that they want to promote growth. How they do that, I'll tell you in a minute. But by buying and selling equal value of government securities, they're not changing money supply, because inflation is already there in the market. Now let's start. Right, so 10-year government securities, they are buying. Now simple question to all of you. If RBI will purchase 10,000 crore rupees worth of long-term G securities, that is 10-year G securities, you tell me what will happen to demand for these G securities. Don't worry about other G securities. Focus on 10-year G security. You know why. 10-year G security is a standard. It is a benchmark. Focus on that. Now, simple question. Let's start now. If the RBI will purchase 10-year G securities, what will happen to demand? Demand will rise up. Demand will increase. Now, you tell me, if the demand goes up, what will happen to market price? Start. Right? If the demand goes up, what will happen to market price? Market price will go up. If the market price goes up, what will happen to yield rate? Yield rate will go down. Opposite. Simple. You have already discussed all of it. If the demand goes up, market price goes up, what will happen to yield rate? Yield rate will fall. Let's say yield rate was 7% before Operation Twist. Now it will fall down to 6%. It will fall down to 6%. Now you tell me, if the yield rate will fall down to 6%, what will happen to interest rates in the market? What will happen to interest rates in the market? Interest rates should also fall, which means now private sector can borrow. Private sector can issue bonds and borrow at lower rate of interest. All of you will agree? Private sector can borrow at lower rate of interest. Don't you think private sector will look at the lower interest rate, issue bonds, borrow, and start investing in the market? Start investing in infrastructure. Start purchasing more and more machinery. start producing more and more goods? Yes or no? Please do let me know. So whenever the interest rates will fall, the private sector will issue bonds, borrow, and start investing. Don't you think that will promote growth in the economy? Simple. Don't you think that will promote growth in the economy? Yes. That is the beauty of Operation Twist. I hope you understand. That is the beauty of Operation Twist. What is RBI doing? RBI is not changing money supply. Follow this. RBI is not changing money supply, because if they want to promote growth, they should increase money supply. Because many of you will have this doubt. Sir, why this so much of circus? And books will not tell you this, but you understand the context. Why are they doing all of this? Because later, after some time, I'll discuss repo rate, reverse repo rate, etc. Most of you will have this doubt. Sir, if RBI can use repo rate, reduce repo rate, which will be done in order to increase money supply, what is the use of Operation Twist? My dear, argument is very simple like this. What if inflation rate is 7%? Think of this. Inflation rate is 7%. Would you want to increase money supply? Right? If you increase money supply, inflation, which is already 7%, it will shoot through the roof. It will go up to 8%, 9%, 10%, and RBI will be held responsible for it. But look at the situation here. RBI wants to promote growth. RBI wants to control inflation. Right? Both of them. Can it be done through Operation Twist? Can it be done with Operation Twist? Answer is yes, by the way. It can be perfectly be achieved through concept of Operation Twist. And this was actually used by Reserve Bank of India during pandemic. During pandemic, when the inflation rate was very high, and the problem of growth, lower growth was there, RBI used Operation Twist to increase to basically reduce the interest rate by using open market operations. Any doubts here? Please do let me know. Right? Any doubts? So this is the function of RBI, Reserve Bank of India, as a lender to Government of India. As a lender to Government of India. So RBI will basically help Government of India to borrow from the market by using G securities. Right? RBI will auction the G securities, help Government of India to raise borrowings from the market. Can I go to the next important function of RBI? Very, very important function of RBI. That is a concept of monetary policy tools. I'm using the term monetary policy tools here. Some of the books will also use this instead of monetary policy tool, credit control tools. Monetary policy tool or credit control tool. And that is one more name for monetary policy. Okay. Now there is a question about repo rate. Let me discuss repo rate first. Let me discuss repo rate. I've not defined what is repo rate, how it can be used, etc., etc. We'll discuss it now. Have patience. What is retail direct gilt? Simple. Under the concept of retail direct gilt, individuals such as you and me can purchase government securities. I'll repeat the statement. Under the concept of retail direct gilt, right? RDG, retail direct gilt, individual investors, individuals such as you and me, we can purchase the government securities. That is a retail direct gilt, RDG. The process is very simple here. Imagine this is an individual investor, you and me. And imagine it is either you or me. We want to purchase government securities. How it can be done? Simple. We will have to open a bank account first. We should have a bank account. And now we will have to open one more account with Reserve Bank of India. And this account is called as Retail Direct Gilt Account. Retail Direct Gilt Account. Any doubt so far? I'll repeat it again. Imagine you want to purchase government securities. I want to purchase government securities. What is the process here? I will have to open one bank account first. Then I will have to open one more account with Reserve Bank of India, which is called as Retail Direct Gilt Account. Now, what is the use of this? Imagine certain government securities are being auctioned by RBI. Same process. Imagine RBI is auctioning government securities. Then I can use the money from the bank account, transfer it to retail direct gilt account, use the money to pay to Reserve Bank of India. RBI is auctioning these G securities. Give the money to RBI, and in return, the G securities will be transferred to my account like this. I'll repeat it again. Simple process. You want to purchase G securities. I want to purchase G securities from RBI. How can we do that? Open a bank account. Open one more account with Reserve Bank of India, which is called as a retail direct gilt account. Now, whenever the auctions are being conducted by RBI, through this retail direct gilt account, you can purchase the government securities. And the money will be transferred from the bank account into the gilt account, then given to RBI, right, which will basically transfer to Government of India. This concept is referred to as a retail direct gilt scheme. Is it okay? Retail direct gilt scheme, RDG scheme. Can I go to the next one? Monetary policy. Can I go to the next one? Monetary policy. Any issues so far? Let me know. Okay, done. Right, so monetary policy tools. A concept of monetary policy tools, which are also referred to as credit control tools. Now, monetary policy tools, there are two types here. One is called as a quantitative tool. Second one is qualitative tool. One is quantitative. Second one is qualitative. Now, what is this quantitative and qualitative? First and foremost, understand this. Quantitative tools are used to either increase or decrease money supply. Is it okay? Quantitative set of tools. Quantity means what? Right? Quantity means number. Simple. So quantitative set of tools are used either to increase or decrease the money supply. And qualitative set of tools, you can either increase or decrease the money supply in specific sectors. Understand this. I'll repeat it. You can increase or decrease the money supply targeting specific sectors. Here, under quantitative, overall money supply can be increased or decreased. In qualitative, specifically in certain sectors, the money supply can be increased or decreased. How it can be done? You will have a look at it in some time. Please have patience. Let me finish up with the quantitative, then we'll take up qualitative set of tools. Now let me start. Quantitative set of tools, which are also referred to as instruments, types of instruments for controlling the credit in the market. The most important one, let me start with that, repo and reverse repo. But if you have been reading the newspaper, reverse repo is no more useful. We'll come to that in a minute. Just have patience. First one is repo. Second one is reverse repo. Now, what do you mean by repo? Follow this carefully. Repo, it is the rate of interest charged by RBI on short-term loans given to banks. Is the definition clear? It's a very, very simple definition. What is a repo? Repo, it is the rate of interest charged by RBI on short-term loans given to banks. For example, imagine your RBI. I will take loan from you for a very, very short duration. For example, I could take it for 1 day. I could take it for 7 days. I could take it for, let's say, 28 days. And generally, the practice is simple here. Short term means less than 1 year. I hope you understand. Short term generally means less than 1 year. So have a look at this. Whenever banks will borrow for short duration from RBI, RBI will charge a rate of interest on it that is called as repo rate. And please remember this, repo rate is the most important policy rate. You'll understand in a minute, just have patience. Repo rate is the most important policy rate. Very simple. Right? Why? What do you mean by that? RBI generally changes repo rate. I hope you understand. RBI, for example, last week, if you have read the newspaper, RBI simply announced we are going to increase the repo rate by 0.25%. All of you read the newspaper? This is what the announcement was there. RBI simply announced that we will increase the repo rate by 0.25%, taking the repo rate to 6.5%. Now, please understand this. Once the repo rate is changed like this, automatically, all the other rates such as reverse repo, right, or for that matter, SDF, standing deposit facility, I'll discuss that, have patience, marginal standing facility, bank rate, etc. Automatically, all of these will change. I hope you understand my statement here. RBI is not announcing change in the bank rate, but because the repo rate is changed, bank rate is connected, MSF is connected, SDF is connected, reverse repo rate is connected to repo rate. So is it okay if I say, if repo rate is increased, all of these rates will also increase? Think of it, right? I hope you understand this. And please do let me in the comment box whether you are following it or not. Because the repo rate is the standard one, all the other rates are connected to repo rate. If repo rate will go up, can I say all the other rates will automatically go up by equal percentage? If repo rate is increased by 0.25, all the others will automatically go up by 0.25. What if repo rate is decreased? All the other rates automatically will decrease. And that's the reason, please follow the monetary policy announcements, at least henceforth. RBI most of the times will only target repo. Simple. RBI most of the times will only target repo. If RBI changes repo, increases it, automatically remaining will increase. If RBI reduces repo, automatically all the others will decrease. Right, so that's a very important point, and that's the reason, remember this, repo rate is the most important policy rate. Now, is the definition of repo okay with you? Repo simply stands for rate of interest charged by RBI on the short-term loans that they are giving to banks. But one point is important, remember this carefully. One point is important, make a note of this. Whenever you talk about repo, whenever you're talking about repo like this, the bank which is borrowing has to provide security, has to provide safety or collateral. What do you mean by this? Have a look at this. Imagine you go to a bank, you will ask for a loan such as, let's say, housing loan. You want to take a housing loan from a bank. Do you think the bank will give the housing loan without taking any security from you? I hope you understand. Do you think the bank will give you a housing loan without taking any security from you? Of course, no. They will take a security which is referred to as collateral, right? Certain asset from you will be taken. Now, many of you will ask me, sir, why? Why are they taking the asset from me? My dear, what if you take a loan and run away? Simple. What if you become Mr. Vijay Mallya ji 2.0? Right, Mr. Nirav Modi ji 2.0. What if you do that? Right, so I hope you understand. That's the reason whenever these kind of loans are provided, RBI will also say, please give me security, give me collateral. So remember this, step one, very simple process. RBI will give loan to a bank. Bank will provide security to RBI. Let's say 7 days. After 7 days are over, RBI will return back the security or the bonds to banking sector, and the bank will provide back or give back the money along with interest to RBI. If I take a very simple number here, imagine the repo rate is 10%. Imagine the repo rate is 10%. What will the calculation? If 100 crore rupees is given in the form of loan, right, after maturity period is over, 100 crore plus 10 crore rupee will be given back by bank. This is how, I hope you understand, this is how the concept of repo rate functions. Now, generally, what does the bank do? Right, later you will understand there's a tool that will discuss that. Bank has a lot of government securities. A bank has a lot of government securities. It could be state government, let's say the state development loans, or it could be treasury bills, it could be dated securities, etc., etc., etc. Bank will provide those securities as collateral to RBI and borrow from RBI. This is basically the concept of repo rate. Now, simple question to you people, you can do this for every rate like this. Is it okay if I say, if RBI wants to promote growth, repo rate will be reduced? Just think of it. If RBI wants to promote growth, repo rate will be reduced. And if RBI wants to control inflation, repo rate will be increased. Does it make sense or not? Please do let me know. If RBI wants to promote growth, repo rate will be reduced. If RBI wants to control inflation, repo rate will be increased. Logic is simple. If they want to promote growth, here is RBI. RBI will give loan to a bank at lower rate of interest. Bank will also give loans at lower rate of interest. If they want to reduce the money supply to control inflation, increase repo rate. Bank will take loan at a higher rate of interest, thereby charge loan at a higher rate of interest. That's basically the transmission. Next one is reverse repo. Exactly opposite. Next one is reverse repo. What happens in a reverse repo? Right? The reverse repo basically stands for rate of interest that is charged by the bank when they will provide loans to RBI. This is a definition. I will give you explanation. Just have some patience. Right? It is a rate of interest that is charged by the banks when they give loans to RBI. Now, what is the actual process which is being followed? Some of you will have a doubt, sir, why will RBI take a loan? It's not exactly that RBI will take a loan, but imagine you are a bank. Just think of this. Imagine you are a bank. You have lot of deposits. You have lot of money in simple terms. You want to give a loan, but you are concerned if you give a loan, the borrowers may not give me the amount back. It can happen, can also happen. So have a look at this carefully. You have lot of money. You will take some of your money, keep it as a deposit with RBI. Is it okay? I'll repeat it again. You have lot of deposits, right? So rather than lending all of it, because it could become very risky for you, what you will do? Part of it, you will keep it with RBI. Now, simple question to you people. When you keep these deposits with RBI, you want to earn interest on it or not? You are a bank, by the way. You are keeping part of your deposits with RBI. Would you want to earn interest or not on it? Please do let me know. Right? If there is anyone who says, sir, no, sir, I will keep money with RBI and I don't want to earn any interest, please don't enter into banking sector. You do not know how to operate a bank. Right? So if you have kept a deposit with RBI, of course, yes, you would want to earn interest. That interest is nothing but reverse repo rate. That interest is nothing but reverse repo rate. What is actually happening here? Banks have lot of deposits. Part of the deposit, they will keep it with RBI. And on this deposit, RBI will pay interest to the bank. That rate of interest is called as reverse repo rate. Is it okay? Is it clear? Anybody has a problem with this? Please do let me know. It's not that actually RBI requires loan. No, RBI doesn't require loan. What RBI says is, you have more deposits, keep it with me. I will give you a certain rate of interest. That is called as a reverse repo. Now, just like in the first one, that is in the repo, just like in the first system, can I simply say, when you will keep deposits with RBI, you would want to collect collateral or security from RBI? Is it okay? Right? Just think of it. It's all very much rational. Right? If I give you a loan, I will collect collateral from you. If you keep money with RBI, don't you want collateral? Don't you want security? Answer is yes, by the way. Right? You want security from RBI. Now, that is also happening under the concept of reverse repo. If I were to write it, it's very simple. Follow this carefully. Step 1. Just like I've written for repo, we can write it for even reverse repo. Here is a bank. Bank will keep money with RBI, and RBI will provide G securities to the bank. This is step 1. And let's say for 7 days or 14 days or 1 day after the maturity period is over, this is step 2. Here is a bank. Bank will get money along with interest, the amount along with interest from RBI, and on the other hand, bank will give back the G securities to RBI. Is it okay? Don't say both are one and the same. Don't say repo and reverse repo both are one and the same. Please have a look at it. In the repo, RBI gives a loan. In reverse repo, RBI takes money. There is a difference. That's a very important difference. Point 1. And point 2, don't you think both under the repo as well as reverse repo, G securities, that is a concept of collateral, security is involved. Very important. Please make a note of this. Why? I'll go to the third tool now. SDF, Standing Deposit Facility. Can I go to the next one? Now there is a very interesting question which is asked generally by one or the other student in every class. Which one is higher, repo or reverse repo? I will not answer it. You think of it. I can answer it. It's very easy because I know that. You just think of it. Which one should be higher? Repo rate should be higher or reverse repo rate should be higher? Right? It's a very simple, right, rational understanding. Oh my dear, 2 of you are basically referring to reverse repo. How? How? Here is RBI. You want RBI to pay higher rate of interest compared to rate of interest that they charge. Right? What is your calculation? What is your calculation? Just think of it. You will keep deposits with a bank and understand this. You will also take a loan from a bank. You want the bank to pay more rate of interest to you compared to the rate of interest that you are paying to the bank. How? In that case, bank will go bankrupt. Right? Just basic application, my dear. These should not be very difficult for you. Repo rate is higher than reverse repo. Right? Repo rate is higher than reverse repo. Okay. Now, repo and reverse repo clear? Let me go to the next one. That is the concept of Standing Deposit Facility. SDF, Standing Deposit Facility. SDF. Okay, let's start. Now, follow the explanation here. If you look at the reverse repo, there is a requirement of G securities. All of you will agree? There is a requirement of G securities. RBI should be having G securities whenever the banks will keep a deposit with RBI. Now, this is a problem. Why? I'll tell you. Imagine you are a bank. You have 100 crore rupees. You will take this 100 crore rupees, go to RBI, and you will tell RBI, sir, I want to keep this deposit of 100 crore. RBI says, okay, keep it. Now you will tell RBI, in that case, when you collect 100 crore worth of money from me, please give me 100 crore worth of G securities. You're asking security. You'll ask, give me 100 crore worth of G securities. Now, what if RBI doesn't have 100 crore worth of G securities? I hope you understand. What if RBI does not have 100 crore worth of G securities? Don't you think reverse repo rate, right, becomes useless here? Or else, can I characterize it like this? Having a reverse repo rate puts a lot of pressure on the Reserve Bank of India to keep G securities at all the time. Any difficulty, please do let me know. I'll repeat it. I'll repeat it again. Under reverse repo rate, when you keep deposits with RBI, RBI is supposed to give you G securities, collateral, right? Collateral. But have a look at this. In the context of this, can you say that having a reverse repo rate means that RBI will always have this pressure of maintaining certain G securities? RBI should always have certain G securities because banks might come to RBI, keep deposits. Now RBI has to provide securities to the bank. Now what if RBI does not have these G securities? Just think of it. What if RBI does not have these G securities? Don't you think reverse repo rate becomes useless? That is a precise reason, right? Have a look at this. RBI has introduced a new tool now, which is referred to as Standing Deposit Facility. Yes, DEF, Standing Deposit Facility. Everybody agrees? Why there is a requirement of SDF? Do let me know. Everybody agrees or not? Why there is a requirement of SDF now? Now, what is the SDF? Simple. It is the rate of interest charged by the banks when they lend to RBI for shorter duration. Now, before you start jumping and asking me, sir, it is reverse repo, etc., have patience. Please have patience. What is standing deposit facility? It is also a rate of interest which represents rate of interest charged by the banks whenever they give loans for shorter duration to RBI. Now, before you tell me, sir, it is same as reverse repo, please have a look at the picture. Please have a look at the picture. Don't you see a difference between how the reverse repo rate works and standing deposit facility works? Right? Just have a look at the picture. It is self-explanatory. You should not have any doubt after this. Right? In the standing deposit facility, is there a concept of collateral? Is there a concept of G security? Is there a concept? Answer is simply no. Right? There is no collateral. There is no G security that will be provided by RBI when the deposits are kept with the RBI by the banks. Right? That's very, very important. Please do not say both are one and the same. Both are different. In reverse repo, RBI has to provide G securities. In the standing deposit facility, RBI does not provide the security. Simple. That's a first very, very important difference. Second very important difference, just apply basic knowledge and answer to my question now. You are a bank here. You have 100 crore rupees. You will keep that 100 crore rupees with RBI, for which RBI will not give you any collateral, any security. Simple question here. Would you want the rate of interest equal to reverse repo or higher than reverse repo? Right? Think of it and answer to my question. I could simply give it. It's a factual information, but once you understand it, it's very, very easy for you. Right? Let's imagine reverse repo rate is 5.5%. Just a hypothetical number. Let's imagine reverse repo rate is 5.5%. But the important fact is, under reverse repo, you get security. You get collateral. Now, under the SDF, you don't get collateral. You don't get security. Would you want to get the same rate of interest? Obviously, no. You would want higher than this. Right? Let's say hypothetically 5.75%. 5.75%. Does it make sense or not? Right? And that's the reason. Please check now. Please check. On one side, a bank has a SDF. On the other hand, bank has a reverse repo. You tell me, will you keep your deposits with RBI under SDF or reverse repo? Right? Think of it. On one side, you have a reverse repo as well as SDF. On the other side, will you keep your deposits with RBI under reverse repo or SDF? SDF. And if you're going to keep your deposits with RBI under SDF, is there any use of reverse repo? Is it okay? Is there any use of a reverse repo now? And that is a precise reason. Please check economic survey. Let me check whether I've given the picture here. Please check the economic survey. This is, by the way, the economic survey of the current year. That is one which was published by Government of India very recently. Just to make an observation. Just to make the observation here. Can you see after a certain time period, the reverse repo rate is not given in the picture and suddenly the orange color line, that is SDF, appears in the graph. Is this okay? Is this okay? Right? Have a look at this. Right? After a certain time period, you will not observe a reverse repo rate and suddenly the SDF, that is the orange color line, will appear in the picture. What does it mean? For all practical purposes, banks are not using reverse repo rate now. Right? For all practical purposes, banks are not using reverse repo rate. They have already jumped to the concept of standing deposit facility. Why SDF is less than repo rate? My dear, what are you listening to? I said SDF is greater than repo, why SDF is less than repo rate? Again, apply the same knowledge, my dear. Apply the same. RBI is lending, RBI is borrowing. You want RBI to pay more rate of interest. You want RBI to function or not? I have to understand. Either reverse repo or, right, let's say SDF, it simply means RBI is taking money. You want RBI to pay more rate of interest compared to what RBI earns by imposing rate of interest. You tell me, is it sustainable? Just think of it, no? Is it sustainable? You'll pay more rate of interest than what you're earning, right? Don't you think within a year itself you'll go bankrupt, right? So that's the reason. These are very, very simple concepts. Don't get confused. You should not be asking these questions. Okay, so is it okay? SDF has been introduced, and right, reverse repo rate, for all reasons now RBI doesn't announce it. It is always focused on SDF as well as right, the concept of repo rate. But make one more observation. I've already told it, but make one more observation. Whenever repo rate has changed, you will see that SDF also changes, MSF also changes, reverse repo in the past also has changed. Is the logic okay? Whenever repo has changed, please be very, very careful, because I know some of you will observe it and say, sir, here reverse repo has kept on changing faster than repo. I'm not worried about it. My statement is simple. Make an observation and tell me, whenever repo has changed, reverse repo has changed, MSF, I'll discuss that, have patience, right? As well as SDF also has changed. True or false? Please observe the graph and let me know. Right? It is correct, by the way. Even if you're not going to answer, I will basically say it. It is correct, by the way, because repo rate is a policy tool. If repo is changed, all the others are connected to repo, they will also change. That is the observation. Now, before I go forward, one more point regarding SDF. You are the RBI governor. Time is how much? 11:40. You are the RBI governor. You are introducing a new tool. Simple question. Should Government of India amend RBI Act or not? Just think of it. You are the RBI governor. You are going to introduce one more tool, right? That is part and parcel of your function. Should RBI amend? Should Government of India amend RBI Act or not? Answer is yes, by the way. Don't have any doubt. Answer is yes, by the way. Right? Some of you will ask, why, sir? Simple argument. Did you see, or did you basically remember, or at least revise the sections of RBI Act of 1934? Sections of RBI Act of 1934. And as I was concerned, some of you are asking why. That is my worry with all of you people. You don't revise. Whatever are the functions of RBI will come from RBI Act of 1934. Now you want to change the function of RBI. You want to make RBI control inflation. You want to make RBI introduce a new tool without changing RBI Act. How is that possible? Just apply common sense. Without making a change in the RBI Act, how is that possible? So that's the reason. Remember this. Government of India amended RBI Act so that RBI could introduce a new tool by the name of standing deposit facility. All of this is okay? Any doubt so far? Right? All of these terms are okay with you? Now, one more very important understanding. Whenever you come across the term standing, right? Understand this. This is one more trick. Easy to remember. Please remember this. Whenever you come across the term standing in any of the tools used by RBI, the term standing simply means the facility is available throughout the year. I'll repeat it again. Whenever you come across the term standing in any of the tools of RBI, it simply means the facility is available throughout the year. Can I give you one more example? There is one more tool by the name of, I'll discuss this, don't worry. There is one more tool by the name of MSF, Marginal Standing Facility. Marginal Standing Facility. Is the term standing there in the right? The name of the tool, yes. What does it mean? What does it actually mean? It simply means it is available, right? It is available throughout the year. Is the concept okay with you? Is the concept okay with you? Right? Basic concept. Repo, RBI will lend, charge the rate of interest. Reverse repo, banks will keep a deposit, banks will earn a rate of interest. But because there is a concept of the security, and what if RBI does not have sufficient security, in that situation, right, the RBI will not be able to collect deposits from the banks. And that is the precise reason we have introduced one more tool now, standing deposit facility, SDF, wherein banks can keep deposits with RBI and RBI does not provide any security. And then that's the reason why SDF rate of interest is higher compared to reverse repo, but both of them are below repo. Shall I go to the next one? Right, shall I go to the next one? Is this facility available to scheduled and non-scheduled? Generally, these are available for scheduled banks. These are very, very important, scheduled banks. Sir, you said in starting that reverse repo rate, name has changed. I did not say name has changed. I said a new tool has been introduced in the form of SDF. That is what I've said. If banks do operation twist with RBI, you tell me, which book says banks are doing operation twist with RBI? You tell me, then I'll give you the answer to that. You are simply creating a new tool. Right? If bank is doing operation twist with RBI, is RBI doing operation twist with a bank? It is doing with all the market. It will basically sell and purchase G securities in the market. Whether you are selling or bank sells or mutual fund sells, doesn't matter. It is doing with whole of the market. Security bond which pledged to RBI, then who collect interest? I don't understand the question. Please reframe your question. I don't understand the question in the first place. Okay, let me continue. So the concept of repo, reverse repo, standing deposit facility. Let me go to the next one. Bank rate. The rate of interest charged by RBI on the loans given to commercial banks. What is the bank rate? It is a rate of interest charged by RBI when they give loans to commercial banks. Now, before you jump and say it is a repo rate, please observe the process. Look at the picture and then tell me, is it repo or not? Right? Both are different and don't be confused. That's the reason generally I tell the students, you might simply buy heart from the book, but if you do not understand the differences for all of this, you'll not be clear with all these concepts. In repo rate, securities are involved. And under the bank rate, generally we don't accept security. Security concept is not involved. Repo rate is only for short term. Bank rate could be for short term, could be for even medium term. But please understand, bank rate also has a huge impact. Right? Bank rate also has a huge impact in terms of how much money is available. How much money is available for the banks to borrow from RBI. And is it okay if I say, if you're going to borrow from RBI, if you're going to take a loan from RBI under the bank rate, that rate of interest will also influence your lending rate. No doubt, repo rate is the most important tool, but understand this, even the bank rate is also the rate of interest which RBI charges on the loans that they're giving to banking sector. Now understand the next point also carefully. There is no security here. All of you will agree? There is no collateral, there is no security here. Now, simple question to you people, if there is no security provided by the bank, if there is no security given by the bank or collateral provided by the bank, should the bank rate be equal, lower or above repo rate? Just think of it. Right? Should it be equal, below or above the repo rate? It should be above the repo rate. All of you will agree? It should be above. Some of you are saying lower. How, my dear? Just apply common sense, no? If security is not involved, risk is generally higher. And when the risk is higher, rate of interest should be higher. Right? Basically, that is the application of economics. Now, is it okay, whatever we have discussed so far, if I write it like this? The standard is repo. The standard is repo rate. Above repo rate, you will have bank rate. Below repo rate, you will have standing deposit facility. And below standing deposit facility, you will have reverse repo rate. All of you will agree with this sequence? Let me know. Right? If I arrange the interest rates in descending order in the market, top will be bank rate. Below that, you will have repo. Below that, you will have a standing deposit facility. And below that, you will have reverse repo rate. Done? Now, along with the bank rate, there is also one more tool called as marginal standing facility. Along with the bank rate, there is also a tool called as marginal standing facility, MSF. Sir, will it be above or below the bank rate? It will always be, right? That is what RBI has been following. It has been equal to the bank rate itself. Whatever is the bank rate, same has been the marginal standing facility rate. Now, what is this marginal standing facility? Simple. There is a statement called as RBI is banker to banks. Understand this. RBI is a banker to banks. Why RBI is referred to as a banker to banks? Simple. Banks can borrow from RBI. I hope you understand. RBI is referred to as a banker to the banks because banks can borrow from RBI. But RBI is also referred to as bank of last resort. Bank of last resort. Why it is called as a bank of last resort? Imagine there is a bank. The bank requires money, emergency, urgently, the bank requires cash. They require money, emergency requirement. Why they will require money in emergency? Give me some time. When you understand CRR, you will automatically get it. So imagine there is a bank which requires money in emergency, right? There is urgency of money that is required by the banking sector. Even in cases of emergency requirement like this, banks can always borrow from RBI. Is it okay? Whenever there is an emergency requirement like this, banks can always borrow from Reserve Bank of India. Now, because the RBI is the facility provided by RBI is available even in case of emergency for the banks, RBI is also referred to as bank of last resort. Is it okay? Right? Any difficulty in understanding this? RBI is referred to as a banker to banks. RBI is banker to government also. RBI is also referred to as bank of last resort for a very simple reason. Whenever there is an urgency or emergency in a bank, they can always approach Reserve Bank of India, borrow from Reserve Bank of India. Done? Now, simple question to you people. Just think of this. Just think of it. Point number one, I'll ask multiple questions. Answer it. You will get all the answers for your questions here. First one, there is a repo rate. Okay, there is a repo rate wherein RBI will provide loans to banks. Question number one, if you are the RBI governor, will you provide unlimited loans to banks under repo rate? Think of it and answer. Right, I'll repeat the statement here. If you are the RBI governor, will you provide unlimited amount of loans to banks under repo rate? Answer should be no, by the way. Why? You do not want to provide unlimited amount of loan. There is always a limit. On what it is decided? Amount of deposits that are there with the bank. And they will decide, this bank, I will give maximum amount of loan based on how much deposits they have. Now understand the next point carefully. You have borrowed under the repo rate. You have already reached the limit. You want to borrow more money. There is an emergency. There is an emergency. You want to borrow more money. In that case, if a bank will approach you, you are the RBI governor. Think like an RBI governor. There is an emergency in the bank. They will approach you. Will you charge them repo rate of interest then? Think of it. Marginal standing facility, they borrow it only for shorter duration. Generally for 1 day. Generally for 1 day they borrow it because there is an emergency like this. Now if the bank manager will approach you, you are the RBI governor, right? They will ask you, sir, I want loan only for 1 day. I will give it back tomorrow. There is an emergency, I want money. Will you charge the repo rate? If you charge repo rate, you are a very, very bad RBI governor. you will charge higher than repo rate. Now tell me, if I write marginal standing facility rate higher than repo rate, does it make sense or not? Is it okay? Because the RBI says you have not managed your finances correctly. Why there is emergency with you? You did not plan correctly. You did not estimate what could happen with your functions correctly. So don't you think that's your mistake? So if I give you a loan for very shorter duration, that is, let's say for 1 day purposes, I will not charge repo rate. I will charge more than repo rate. That is basically penal rate of interest. Is it okay? Penalty, right? Penal rate of interest basically means a penalty higher than repo rate. Now, many of the times you will read it like this. Many of the times they will simply write the MSF like this. Understand this. Is equal to, they will write repo rate plus 25%. That is 0.25, not 25%, 0.25%. What is this 0.25%? It is a penalty for you. Because you did not manage your finances correctly, there is an emergency for you. So what will I do? I will impose a penalty on you. Higher rate of interest than the repo rate. Now some of you are asking, is marginal standing facility is equal to both or one and the same? No. Bank rate is different. Marginal standing facility rate is different. But right now, if marginal standing facility rate is, let's say, 6.8%, even the bank rate has been fixed at 6.8%. That's the reason I've used equal here. Is it okay? Both are different. Both are different. But right now, rates are same. Right? If the bank rate is, let's say, 6.8, even the MSF rate is 6.8. Is the logic okay with you? Can I go to the next one? Can I go to the next one? Right? So, repo, reverse repo, right? Bank rate, standing deposit facility, right? Marginal standing facility, right? All these are basically the types of tools, right? That is used by RBI to regulate money supply. Okay, regulate money supply. Is collateral used in the MSF? Yes, collaterals are used in MSF. Okay. Let me go to the next one. Right, a statutory liquidity ratio. Now, before I go to the next one, right, understand this carefully. If you talk about repo, reverse repo, STF, marginal standing facility, bank rate, can you observe one thing? Overall money supply in the economy is either increasing or decreasing. Just make that observation, right? Overall money supply in the economy is either increasing or decreasing. There is no targeting of any sector. Is it okay? Right? I'll repeat it. You can take any of the tools, repo, reverse repo, marginal standing facility, or for that matter, let's say, what is that? SDF. Overall money supply in the economy either will go up or will go down. In any of these tools, we did not target any specific sector. We did not target housing sector. We did not target, let's say, automobile sector. We did not target agriculture sector. Nothing. Overall money supply, either it increases or it decreases. Shall I go to the next point now? Shall I go to the next point? Next important point is there is a tool called as liquidity adjustment facility. Liquidity adjustment facility, LAF, liquidity adjustment facility. Now this concept of liquidity adjustment facility was introduced by RBI. What is the idea of a liquidity adjustment facility? Simple. Using the tools, RBI will either increase or decrease liquidity in the banking sector. Is it okay? I'll repeat it again. Using the tools, RBI will either increase or decrease the liquidity in the banking sector. What do you mean by liquidity? The amount of cash that is there with the banks. Simple. Amount of cash that is there with the banks is called as liquidity. Any difficulty here? Please do let me know. For example, I'll give a very simple example. Imagine you have 100 rupees. You will keep this 100 rupee with the bank in the form of deposit. Can I simply say that the liquidity with the bank is 100 rupees? Is the logic okay? Can I say that liquidity with the banking sector in this example is 100 rupees? Either say yes or no, so that I will decide to go to the next point, or I will repeat it again. Right? Which deposits are doesn't matter. It is either, let's say, fixed deposit or right savings bank account. I'll repeat it again. Liquidity means the cash that is available with the banks, which they can use for lending purposes. That is called as liquidity. Now, if you take your 100 rupees, deposit that with the bank, only one transaction. You have 100, you'll keep that 100 rupee with the bank. Can I say liquidity with the bank is 100 rupees? Agreed? Now, RBI, by using repo or reverse repo, RBI, by using repo or reverse repo, can they change this liquidity with the banking sector? Can they change liquidity in the banking sector? Right? Possible or not? Under repo, money will be given to bank. Liquidity with bank will change. Arey Baba, how difficult it is to understand. Liquidity means, I don't understand. Let's follow this. Liquidity means what? Money that is there with a bank, which they can use to give loans. If RBI will give, let's say, 100 crore rupees to bank, don't you think now bank has 100 crore rupees to lend or not? That's simple. Right? If RBI will give 100 crore rupees to a bank, don't you think bank has 100 crore rupees to lend in the market? Of course, yes. Right? And if RBI will take away deposits, that is, let's say under reverse repo, RBI will take away the deposits from the bank. Don't you think liquidity in the banking sector will come down? Right? That's the reason repo and reverse repo are generally mentioned under the concept of liquidity adjustment facility, LAF. Okay. Next, concept of statutory liquidity ratio, SLR, statutory liquidity ratio. Now, before I go forward, I'll discuss one point, then we'll take a short break. Have patience. There is a term called as statutory reserve requirements. Statutory reserve requirements. Statutory reserve requirements. Now, what do you mean by statutory reserve requirements? Some of the reserves that RBI has to maintain. Some of the reserves that the banks will have to maintain. Now, what are the statutory reserve requirements? One is called as a CRR, cash reserve ratio. One is called as SLR, statutory liquidity ratio. Both of them generally are referred to as reserve requirements, right? SRR, statutory reserve requirements. We will have a discussion regarding statutory reserve requirements after the break. But before that, let me address some of your questions. GSAP has been discontinued now. Don't worry. It was used a couple of years ago. Now it is not being used by RBI. Has been discontinued. Can bond be issued at compound interest too? Who will issue at compound interest? How will you calculate at compound interest? You tell me. Anybody who issues a bond annually will give you the coupon rate. Annually they will give you the coupon rate. So how do you compound it? You tell me. Right? So simply you're trying to complicate the whole issue. How interest rate increases? Simple. Whenever the demand for the bonds will increase, obviously the market prices will increase. And when the market prices will increase, yield rate will fall down, thereby reducing the interest rates. I want to know only what is interest rate in open market operation, coupon interest or something else. Interest rate generally means whatever is the returns on your investment. Simple. Whatever is your returns on the investment, that is generally the interest rate. For example, I'll take a very simple example. Imagine this bond is being issued right now by the government. I hope you understand. Right now, it is being issued by the government. right? Imagine the coupon rate is 8%. So your interest rate will be 8%. You purchase it at 100, you will get interest rate at 8%. That is your returns on the investment. But rather than purchasing this, you will purchase something else in the market, other bond in the market, on which you will pay 95 rupees, but you will earn 8%. You will earn 8 rupees on it. That is the interest that you are earning. But as a percentage, when you calculate 8 rupee earned upon 95 rupees, that is called as yield rate. G security, which collateral with RBI, then who collect return on security? Anybody who is owning the security, that is very important, owning the security will collect the security. You have pledged the securities, you have not sold the security. I hope you understand. You have pledged, you have basically given the security, you will collect it back, right? It's not that you have sold the securities there. Under repo, reverse repo, you have basically kept the collateral, you have not sold the collateral. It's like asking, sir, I have a house, I've kept the house as a collateral with the bank, I've given the house on rent. Who will collect the rent now? Who owns the house? Right? I hope you understand. Who owns the house? You're not selling the securities, you're giving the securities as a collateral. Okay, right? So let's take a break now. I'll restart at 12:07. It's 12 o'clock. I'll restart at 12:07. Right? Take a small break. Okay, welcome back. Can we start? Am I audible? Can we start? Okay, let's start then. So first one is statutory liquidity ratio, SLR. Now before explaining the concept of SLR, I want you to understand one idea, that is the concept of NDTL. And the idea of NDTL, right? What is this NDTL? Net demand and time liabilities. Let me explain this. Follow this carefully. Here is a bank. Okay, here is a bank. Now the bank will collect the deposits and give loans. All of you will agree? That's simple. The bank will collect the deposits and give loans. Now the deposits that are collected by the bank, don't you think the bank will have to return it? Bank will have to give back the deposits. Any disagreement, please do let me know. And on the other hand, the bank has given loans, the bank will earn interest on it. Bank will earn interest on the loans. Now, is it okay if I say deposits are nothing but liabilities for a bank? I'll repeat it. Deposits are nothing but liabilities for a bank. And the loans are nothing but assets for a bank. Any problem here? Liabilities are nothing but the amount that you will have to repay. Simple. Assets means something that will bring returns to you, something that will bring, let's say, interest or profits to you. So the loans which are given by the bank, right, these are nothing but the assets for a bank. The deposits which are collected by the bank are nothing but liabilities for a bank. Is the logic okay with you? Any issue, please do let me know. Next, these deposits are further divided into two types. One is called as a time deposit and second one is called as a demand deposit. One is a time deposit, second one is a demand deposit. What do you mean by demand deposit? The money in these deposits can be withdrawn. Money can be withdrawn at any point of time. Money can be withdrawn, right, at any point. Very simple. For example, salary account, savings bank account, etc. Will you not withdraw the money from savings account whenever the demand arises? Whenever you want to spend money, you will withdraw the money from the savings bank account. That is a demand deposit. What about time deposit? These deposits are there for specific time period. These are kept for a specific time period with bank. These are kept with specific time period with a bank. For example, fixed deposit. Fixed deposit is an example for time deposit. Savings bank account is an example of demand deposit. Any difficulty so far? Can I go to the next one? Can I go to the next one? So the deposits can be divided into two parts, time deposits and demand deposits. And can I simply say both put together are the liabilities for a bank? I repeat, the time deposits as well as the demand deposits put together are the liabilities for a bank. Now look at the term net demand and time liabilities. Is it okay? Right? What do you mean by net demand and time liabilities? Right? Is the logic okay here? Right? Net demand and time liabilities are nothing but the deposits which have been collected by the bank, which they have to return. Simple. Which they have to give it back. Now, what is the importance of this? Follow this carefully. Now, there are two terminologies. One is a CRR, cash reserve ratio. Second one is SLR, statutory liquidity ratio. And both of them put together, these are called as statutory reserve requirement. Now, have a look at this. First, SLR. It is the percentage of NDTL that the banks will have to keep with themselves. Remember this very carefully. SLR is the percentage of NDTL that the banks will have to keep with themselves. That is, let's imagine a bank is there. This bank has collected, I'll take a simple number, let's say 100 crore rupees worth of deposits, and let's say hypothetically RBI has told SLR is 20%. Right now it is somewhere around 19.5. Let's say hypothetically 20%. What does it mean? 20% out of this deposits collected by the bank has to keep with itself, which means that 20% bank is not allowed to use for lending activities. Right? Any problem? Please do let me know. That 20% the bank is not allowed to use for lending activities. That is, let's say hypothetically 100 crore, I will divide this into 80 crore and 20 crore. This 20 crore the bank cannot use for lending purposes. Remaining 80 crore it can use, but that 20 crore it cannot use. Any doubts? Next point. When the bank will keep this 20 crore with itself, how it is supposed to keep? Either they can keep it in the form of cash, they can keep it in the form of government securities, it could be treasury bills, it could be sovereign gold bond, it could be dated securities, it could be state development loans, etc. Or they can purchase gold and keep. Right, so again I'll repeat it. What is statutory liquidity ratio? The bank which has to take this, the bank which collects the deposits, part of the deposits, the bank has to keep with itself, either in the form of cash, or in the form of gold, or in the form of government securities. This is called as statutory liquidity ratio. Can I go to the next one? Can I go to the next one? CRR, cash reserve ratio. One is called as SLR, second one is CRR. Again, I know 12, 15, etc. Right? Some of you are hungry, some of you want break, etc. We'll take the lunch break at 1 p.m. Participate here. Can I go to the next one? Right, some of you are asking about corporate tax here. I'm discussing about the SLR. You want me to discuss about corporate tax rate, right? So have patience. When I'm taking a break, please reserve your questions related to other chapters there. Right? I cannot stop discussing banking, go to that corporate taxation. It doesn't make any sense. Right? So logic is simple. Percentage of the deposits collected by the bank, they will have to keep it with themselves, either in the form of gold, in the form of cash, in the form of government securities. Now, before going forward, let me ask you a very simple question. Imagine you are the bank manager. You'll have to keep 20 crore rupees out of 100 crore deposit that you've collected. Between cash, government securities and gold, you tell me which one will you prefer? Right, have a look at this. Between cash, gold and government securities, you tell me which one will you prefer? It should be very rational decision as well. It's not very difficult. It should be rational. Right? It is government securities. Some of you are saying gold. For whatever reason, I don't know. You're saying gold. My dear, gold prices fluctuate. Right? Just apply common sense, no? Forget about everything. Apply common sense. Are you investing your money or depositors' money? You want to invest in an asset whose prices will fall, rise to a very great extent within a month. Or you want to, right, keep it in government securities, which are safest bet in the market. Safest, right, which are very, very safe in the market. And two of you are saying cash. Why? Why do you want to keep it in the cash? Right, don't you think you should invest somewhere? Just apply basic knowledge. Na? If you keep it in the cash, where will you have money to pay to customer? Because you will have to pay interest to the customer. I hope you understand that as well. You're a bank manager. You have collected 100 rupees from me. You will keep 20 rupees out of it. You will use only 80 rupees. Then on that 20 rupees, if you keep it in the form of cash only, where will you get the interest to pay on that 20 rupees? Just think of it. That is the reason, right? That is the reason, right? Just understand this. You will prefer G securities, right? You will see G securities, right? And these are safe, and you will invest in the G securities. Okay, right? Let me go to the next one. But sir, RBI can't buy G securities bond then. Who said? If you purchase G securities and keep it, RBI says you can use these G securities under repo. Simple. A bank has G securities. Bank wants to borrow from RBI then use the G securities that you already have under the SLR. Then you can use it. Right? So, very, very basic knowledge. Next one, CRR, cash reserve ratio. CRR, cash reserve ratio. Right? What is this CRR? It is the percentage of NDTL, net demand and time liabilities, that the banks will have to keep with RBI. Right? Don't say both SLR and CRR one and the same. Understand the concept carefully. Right? SLR, bank will have to keep with itself. CRR, percentage of NDTL, bank has to keep with RBI. Let's say hypothetically, CRR is 4%. Let's take a simple number. Let's say CRR is 4%. You have collected deposits worth 100 crore rupees. 4% out of it, you will have to keep with RBI. That is simply 4 crore rupees. Now, what is the reason? Why does RBI do this? Simple. If you are allowed to use all the 100 crore rupees, you will use it, give loan to the borrowers. Don't you think you are taking a very high amount of a risk in the market? Is it okay? I'll repeat it. If you have collected 100 crore, if nothing, you will have to keep on the side, everything you are allowed to use it for lending purposes. Don't you think you will lend all the 100 crore because you want to earn more profit? Logic is simple. You want to earn more profit. But if you keep giving all the 100 crore rupees in the form of loan, you are taking very high amount of risk. That is the precise reason. Part of this deposit, RBI says you keep it with yourself. Remaining, right, or out of the deposit, certain percentage you keep it with me. And before I go forward, SLR has to be maintained separately. CRR has to be kept with RBI separately. Both are not one and the same. Both have to be kept separately. Meaning what? Imagine SLR is 20%. I'll take simple numbers here. Imagine SLR is 20% and the CRR is, let's say, 4%. And your deposits are worth 100 crore rupees that you have collected. Which means out of 100 crore, you will have to keep 20 crore rupees with yourself. Remaining 4 crore rupees, right? I'm sorry, another 4 crore rupees you will have to keep with RBI. Right? So 20 crore with yourself, 4 crore with RBI. You are left with 20 plus 4, 24. Out of 100, if you remove 24, 74 crores, you can use it for lending purposes. Now, simple question to you people. One, can I say that by implementing these kind of tools, RBI is protecting the interest of the depositors? Understand my statement here? CRR, SLR, etc. Right? By implementing these kinds of tools, RBI is protecting the interest of the depositors. One. And by changing the rates, is it okay if I say by changing the rates, for example, imagine SLR is increased from 20% to, let's say, 25%. What is the impact of it? If RBI increases SLR from 20% to 25%, what is the impact of it? Now out of 100 crore, 25 crore you will have to keep it here with yourself. Another 4 crore you will have to keep anyways with RBI. Now you will be left with 71 crore rupees to lend. Don't you think the lending activities, that is the loans which are given by the banks, would be affected? I hope you understand. Money supply would be affected in the market by changing CRR, by changing SLR. So the objectives of RBI are very simple here. You are collecting deposits. I don't want to use all the deposits. Then you are taking very high amount of risk. So I will collect some of the deposits with myself. I will ask you to keep some of the deposits with yourself. And if I keep on changing these rates, money supply automatically can be changed. If SLR is reduced, we expect money supply to increase. We expect. If SLR is increased, we expect money supply to come down. Right? Any issue here? Any issue? Please do let me know. CRR is generally fixed in the range of 3% to 15%. Understand this. CRR is generally fixed in the range of 3% to 15%, point one. And second point, any deposit that the banks will keep with RBI under CRR, RBI does not pay any interest on it. I'll repeat it. Any deposits that the banks will keep with RBI under CRR, RBI does not pay any interest on this. So these are some of the very important parameters, or let's say features associated with the quantitative set of tools. So we are done with the quantitative set of tools. Before I go forward, now you have any doubts regarding quantitative set of tools, please do let me know. And regarding corporate tax, don't worry, before I take the lunch break, I will address your query. We'll take up the question at that point of time. Shall I go to the next one? Why banks agree to no interest? There is no question of banks agreeing. RBI has decided the policy. It's not an option for you. I hope you understand. It's not an option for you. If RBI increases repo rate, do you think whether you agree or not as a bank has an impact on RBI policy? Absolutely no. RBI says this is the policy, simply follow it. Okay? Any doubts? At present, what are the rates? Please check the RBI website. Please check RBI website. No, and don't buy at those rates. Trust me. After 1 or 2 months, again the rates will change. Why? Why do you want to buy at it? I'll go to the next one then. One is basically the quantitative set of tools. Now I'll start discussing qualitative set of tools. Qualitative. Okay. Qualitative set of tools. So quantitative are over. Let me enter into qualitative. Let me start with the first one, rationing of credit. Concept of rationing of credit. Now, what do you mean by rationing? First and foremost, understand this. Rationing means distribution. Simple. Rationing simply means distribution. Have you heard of ration shops? What do ration shops do? They distribute food grains. Now look at the term here, rationing of credit. Right? What do you mean by rationing of credit? RBI under this policy will decide how the loans have to be given in the market. Simple. Right? How the loans have to be given in the market. Sir, why does RBI do this? Let me ask you a very simple question. Imagine you are a bank manager. Right? Imagine you are a bank manager. Apply rationality, you will understand. Would you want to give more loans to businesses, or you want to give more loans to agriculture sector? Think of it and answer. Let's see. You're a bank manager. Right? Now you are given a free hand. Freedom. Now you can decide to whom to give loans, how much to give loans. Would you want to provide more and more loans to businesses or agriculture sector? Most of you are correct. You will decide to give loans to businesses. And if an option is given, if a choice is there for you, you will simply say, sir, I don't want to give loans to agriculture sector. And again, don't say, sir, right, how can you decide not to give loans to agriculture, right? The farmers are important, etc., etc. Think as a businessman. Simple. Think like a businessman. Here, there are better chances of getting the money back compared to agriculture sector. Why? When we discuss agriculture sector, you will understand it. In India, most of the cultivation that is done is dependent on monsoon rainfall. I hope you understand this. Most of the cultivation that we do in India is dependent on monsoon. Now you tell me, is there any guarantee of how much monsoon rainfall you are going to receive? Any guarantee? Right? Absolutely no guarantee. You could get more rainfall, less rainfall, appropriate rainfall, etc., etc., etc. All I'm trying to convey is very simple. By giving a loan to some of the sectors, banks will take very high amount of risk. Is the logic okay? By giving loans to some of the sectors, banks are taking higher risk. Now, if there is no regulation, as a bank manager, will you provide loans to agriculture sector? If there is no compulsion on you, right? The RBI says you decide. To whom you want to give loan, you decide. Will you give a loan to agriculture sector? You will stay away from agriculture sector as far as possible. Now come to the reality then. Should we do that? Should we give the freedom to the bank manager or banks to decide how much loans they want to give to agriculture sector? Answer is simply no. You should not give that choice. Why? If you give that choice, they will definitely reduce the loans that they are going to give to agriculture sector because it is risky. Simple. Because it is risky. That is the precise reason what RBI has done is, under a policy called as rationing of credit. Rationing means distribution of credit. They have a tool by the name of priority sector lending, PSL. Under the concept of rationing of credit, right, basically they have a tool by the name of priority sector lending, PSL. Very, very famous, very often used in the newspaper. Follow this carefully. Under PSL, RBI says that if you are a bank and you are giving a loan, certain percentage of loans, although they use a technical term here, adjusted net bank credit, don't worry about it. It simply means total amount of loans. So percentage of credit or percentage of loans which are issued by the bank should go to some of the sectors which are decided by RBI. For example, 40%, right now it is 40%. 40% of credit that is issued by the bank should go to agriculture sector, MSME, export, startups, right, housing sector, right, or export credit, etc. So these are some of the areas, these are some of the sectors where RBI says you don't have an option, you don't have a choice. You will have to provide 40% of your loans in these sectors only. Is the logic okay? Right? Is the concept okay with all of you? Please do let me know. Now understand the next point carefully. If you remember, when I started discussing monetary policy tools, I'd used a statement. I told you that under quantitative set of tools, either you will increase or decrease the money supply in the overall economy. But I said in qualitative set of tools, you can increase or decrease the money supply specifically in some of the sectors. You can target some of the sectors. Either you can increase the money supply or decrease the money supply in these sectors. A simple question to you people. If PSL is increased, don't you think the money supply in these sectors will increase? Think of it. Just think of it. If PSL is increased, don't you think the money supply in these sectors will increase? Can we target specific sectors under PSL? Answer is yes. Now can I go? I'll go to the next point. Understand this. Now can I categorize qualitative set of tools as specific credit control tools? Is it okay? Right? Can I categorize and call these qualitative set of tools as a specific set of tools or specific credit control tools? And can I call the quantitative set of tools as general credit control tools? I'll write it in the first slide so that you remember it and you will get this particular slide. Right? So understand this carefully. Because we can target specific sectors, change the money supply in these sectors, I will also refer to the qualitative set of tools as specific credit control tools. Specific credit control tools. And because under the quantitative, I cannot target a sector, overall money supply will go up or go down in the economy, I will refer to the quantitative set of tools as general credit control tools. General credit control tools. Any difficulty in understanding specific credit control tools and general credit control tools? Please do let me know now. Right? I hope you understand this. Why this is called as a specific? Why this is called as a general? Because under quantitative, you can regulate the money supply in the economy, not in a sector. In qualitative, you can regulate the money supply in specific sector. That is the reason it is called as a specific set of tools. Now that is the first one, the PSL, priority sector lending. Second one is regulation of consumer credit. Regulation of consumer credit. Now follow this very carefully. Imagine right now, right, simple numbers. Imagine right now, people who want to take a housing loan, right, the bank will simply say, monthly, I will ask you to make a payment of, let's say, 40,000 rupees payment, installment. If you have a loan, or if your parents have a loan, they'll keep on saying, I need to make an installment payment. I need to make, right, an EMI payment, etc. Applicable to housing sector, applicable to personal loans, applicable to consumption loans, that is a four-wheeler loan, two-wheeler loan, etc., etc. Now understand this very carefully. Imagine right now the payment that you're supposed to do on monthly basis is 40,000. A simple question to you. What if the bank will reduce that monthly payment component to 20,000 rupees? Now a loan product is available to you. You can take a loan and you don't have to pay more amount monthly. You can pay simply 20,000 rupees monthly. A simple question to you people, just think of it and answer. What do you think will happen to these kind of loans? Right? What will happen for demand for these kind of loans? People will start taking more and more of these loans. And when you take these kind of loans, consumption will also increase. Right? Don't you think the demand, consumption will increase? Now, can it be used to promote growth? Simple. Can it be used to promote growth in the market? Answer is yes. But imagine on the other hand, right, already the loan is offering you 20,000 monthly payment. Demand is higher, right? There is an inflationary trend in the market. The bank will simply say, no, henceforth the loans that I give, I will not be asking you to make a payment of 20,000. I will ask you to make a payment of 40,000 rupees. Now you tell me, if the monthly payment increases like this, what do you think will happen to demand? Don't you think if the component is increased, demand in the market automatically will go down? This will help in controlling inflation. Is it okay? This will help in controlling inflation. Can we do this specifically for housing sector? Can we do this specifically for two-wheeler loans, four-wheeler loans? Right? Can we do this? Of course, yes. Now, simple question to you. Right? Is it not specific a set of tool? Are we not regulating the money supply in the economy using or targeting a specific sector like this? This is called as a regulation of consumer credit. Right? People take a lot of loans. Again, don't say, sir, I've never done it. I'm not talking about only one of you. Talk about whole of Indian economy. Don't you think people take a lot of consumer loans in India? For two-wheelers, for four-wheelers, for tractors, I hope you understand, for housing, etc., etc., etc. So we can regulate, promote the growth or reduce the inflation by regulating how much loans are issued and how much is the payment that is done for it. Right? That is basically the consumption credit. Let me go to the next one. Variation of margin requirements. Variation of margin requirements. Margin simply refers to what? The safety or collateral that is kept. Let me explain this. Imagine you'll go to a bank. You want to take a housing loan. Now, do you think if you want to purchase 2 crore worth of the house, just think of this. You want to purchase 2 crore worth of the house. Do you think the bank will give you a loan of 2 crore rupees? How many of you think this is correct? You want to take a 2 crore rupee house, bank will give you a loan of 2 crore rupees? Absolutely no. Right? If you think, sir, they can do it, you are wrong. They will never do that. They will never do that. What they will do is, sir, right? You want to take a house worth 2 crore rupees? Agreed. You want a loan from me? Agreed, I'll give it. But not 2 crore rupees. What we will do is, let's say 80% of it, I will give it in the loan, which is 1.6 crore rupees. I'll give it in the loan. And remaining, right, 40 lakh rupees, you pay from your pocket. Right? The technical term is down payment. The technical term they use is down payment. From your pocket, you pay 40 lakh rupees. From the bank, we will give 1.6 crore rupees. Now, this down payment is basically nothing but margin. Is it okay? The down payment is nothing but margin. A simple question to you people. If the margin is increased from 40 lakh rupees to, let's say, 60 lakh rupees, I hope you understand. If the margin requirement is increased from 40 lakh rupees to 60 lakh rupees, you tell me what will happen to these kind of loans. Start answering. Right? If the margin requirement, which was earlier 40 lakh rupees, now has been increased to 60 lakh rupees, which means now the bank says, I will give 1.4 crore rupee loan, but from your pocket, you put 60 lakh rupees. Down payment. Don't you think the demand for such loans will go down? Right? If there is an inflation in the market, right, automatically the demand will be controlled. Inflation can be controlled. Now, on the other hand, rather than 40 lakh rupees, what if the bank says, not 40 lakh, you pay only 10 lakh rupees? Right? You don't have to pay 40 lakh rupees, pay 10 lakh rupees. Margin requirement is reduced. Now, what will happen on the other hand? The demand for such loans will increase. People will take more loans, people will purchase more, people will consume more. Right? Is the logic okay? Right? This is called as variation of margin requirements. And don't say, sir, regulation of consumer credit as well as variation of margin requirements are one and the same. Absolutely no. In margin requirements, we are talking about initial down payment. Initial down payment. And on the other hand, regulation of consumer credit, we are talking about changing the repayment amount. Both are different, both will act at different points. Any issues here? Right? Any issues here? Did not understand down payment. My dear, when you take anything in the market, you will have to make certain payment. Right? Just ask your parents. You'll have to make certain amount of payment. That is called as a down payment. Down payments are usually done by the buyers by taking the money from their own pocket. That is basically a down payment. Okay. Next one. Direct action, moral suasion, and publicity. Right? Direct action, moral suasion, and publicity. Now, let me start with the last one, publicity. Now, very often you must have seen advertisements wherein Mr. Amitabh Bachchan gives you certain information regarding RBI policy, right? Or cricketers giving you information regarding RBI policies. Have you seen those ads? Right, where Mr. Amitabh Bachchan is there, right? They will say RBI kehta hai, etc., like this. A simple question to you, whether it is a cricketer or let's say the Amitabh Bachchan, right, or whatever it is. What is the advertisement trying to do? What is the ad trying to do there? The advertisements are given so that you understand what is the policy of RBI. Simple. You should be aware about what is the recent policy of RBI. For example, I'll give you an example. Follow this carefully. There is one ad. If you have not seen it, it simply means you don't even watch TV carefully. Forget about reading. You don't even watch TV carefully. There is one ad which comes where the clothes are put in the washing machine. Now the clothes are removed. Suddenly the person realizes there were currency notes in the clothes. Have you seen that? They will remove the currency notes and the currency notes have already become crumpled. Crumpled means they have basically been squashed in the washing machine. Now the advertisement gives you information saying that don't worry, If the notes have become crumpled, you don't have to worry. Go to the nearest bank and you can exchange these currency notes. Now, simple question to you. Don't you think by these advertisements or newspaper articles, etc., RBI is trying to educate the customer? RBI is trying to create awareness amongst the people. That is nothing but publicity. Is it okay? That is nothing but publicity. It is to promote effective public opinion for the policy implementation. Meaning what? If the customers know the policy of RBI, the banks will be forced to implement the policy. Is the logic okay? Right? Whether the bank knows or not, if the customer knows the policy, the bank will now be forced to implement the policy. Next, moral suasion. What is this idea for moral suasion? RBI will be asking the banks to cooperate and implement the policies of RBI. Sir, how can RBI ask? RBI governor will give a speech, and in the speech, RBI governor will say, banks are doing A, B, C, which they are not supposed to do. RBI, right, have a look at this. RBI has basically called for a meeting and they will warn some of these banks which are not following RBI policies. RBI will send a circular, right, or a show cause notice to a bank asking for explanation of certain policies. All of this is what? All of this is nothing but moral suasion. So one is a publicity, second one is a moral suasion, third one is a direct action. What is the idea for direct action? RBI imposing certain penalties on the banks. And very often you will come across newspaper article where RBI has imposed 1 crore rupee penalty on a bank, 5 crore rupee penalty on a bank. That is called as a direct action by RBI. Right? Any issue with these particular policies? Do let me know. Right? Any issues? One is the instruments which are used for general increase or decrease of money supply in the economy. Second one, right? Second one, basically a qualitative set of tool where targeting will be done to either increase or decrease the money supply in the economy. Give one more example of moral suasion. My dear, how many examples? I told you RBI will call for a meeting, warn the banks. RBI will send notices asking for explanation. RBI governor or deputy governor will give a speech warning about non-following of these policies. RBI authors will write, let's say, papers, right, saying that these banks are not following, etc., etc. All these are the examples of moral suasion only. Okay, so these are the tools that RBI will use under monetary policy. Any difficulty in understanding monetary policy? This is the end of monetary policy for you. Any difficulty here? Can I go to the next one? If nobody answers, then by default, I'll go to the next one. Can I go to the next one? Can we change our currency notes if they get destroyed from some side? What do you mean by destruction? You tell me that. Right? If you basically tear the currency note, only half you have, you can't run to the bank to get it exchanged. So what do you mean by destruction? You tell me that. ANBC, adjusted net bank credit. Basically, it's a type of a calculation of how much total loans are issued by the bank. Now, technical calculation, you don't have to follow it. Simply understand it is the total loans issued by the bank. Simple. It is the total loans issued by the bank. Just read that statement, more than sufficient. Okay, let me go to the next one. Now, yesterday there was one question, generally in the second session, that is basically in the last part of the session yesterday. How does RBI decide when to increase the money supply, when to decrease the money supply? Let me answer that. Now, there are different types of tools which are practiced and calculated by RBI. M0, M1, M2, M3 and M4. Be very, very careful with this. M0, M1, M2, M3 and M4. 5 types of measurements are there. M0 is referred to as base money. Base money or else it is also referred to as high powered money, or else it is also referred to as high powered money, right? Or third name, monetary base. Okay, understand this. M0, it is referred to as a base money, high powered money, or monetary base. Now what is M0? M0 includes currency in circulation plus bank deposits which are there with RBI and other deposits which are there with RBI. That is, bank will keep deposits with RBI. All of you will agree with me? Banks will keep deposits with RBI. Don't you think that the type of, let's say, CRR or let's say under repo rate, these are the deposits that the banks will keep with RBI. And what are the other deposits with RBI? Central government will keep deposits with RBI. State governments will keep deposits with RBI. So understand this, M0 is called as base money or high powered money or monetary base. But what is the meaning of it? M0 represents the total liability of RBI. Simple. It represents a total liability of RBI. Please be very, very careful. It represents a total liability of RBI. Right now, for example, I'll come to the first part of the statement. Just give me some time. If a bank has kept a deposit with RBI, don't you think the RBI has to return the deposit? Simple question. Bank has kept a deposit with RBI. Don't you think the bank will get these deposits back from RBI? So in the context of banker deposit as well as other deposits with RBI, is it okay if I directly say this is a liability of RBI? This is nothing but a liability of RBI. But what about currency in circulation? Slightly technical. Understand this very carefully. Slightly technical. Currency in circulation, why do we say currency in circulation is a liability of RBI? Let me give you explanation. Follow this very carefully. Follow this very carefully. Now, imagine RBI has printed this 100 rupee. Is it okay? Right? Almost lunchtime. Imagine I am the RBI governor. I have printed this 100 rupee note. Now, simple question to you people. How do I ensure that this 100 rupee will enter into the supply in the market? Will I directly give it to you like this? I hope you understand. Will I simply give you like this 100 rupee? Of course no. Of course no. Right? Understand this. If I'm giving you 100 rupee, will I collect something from you? Is the logic okay? Right? I repeat. I'm giving you this 100 rupee. Will I collect something from you? Of course, yes. Now follow this carefully. Imagine, I'll take a simple example, right? Don't worry about it. I'll take a simple example. Imagine you have kept this particular government security. You have this government security, 100 rupee. You will give it to me and I will give you this 100 rupee. Now, right, don't you think, let's say, after 1 day or after 7 days or after 1 year, whatever it is, you will give the 100 rupee back to me. I will have to give this government security to you back. Agreed? I hope you understand. Right? You have taken 100 rupee. You will give the 100 rupee back to me. I will have to return the government security to you. So this 100 rupee that I've issued and I've got 100 rupee worth of G security that is there with me. If you give the 100 rupee back, I'll have to give the G security. Can I write this 100 as a liability of RBI? Simple. Can I write this 100 rupee that is printed and issued by RBI as a liability of RBI? Anybody has a difficulty, please do let me know now. Right? It's a simple concept but slightly technical. The currencies which are printed and issued by RBI are nothing but the liabilities of RBI. Anybody has an issue? Can I go to the next point here? Can I go to the next point? Nobody wants to answer. Right? How? My dear, understand this. Again, RBI has printed 100 rupee. RBI doesn't give the 100 rupee just like that in the market. RBI has to collect something from, right, the bank. So when RBI will give this 100 rupee, RBI will collect something equal to 100, let's say. So value is simply 100. 100 rupee given, 100 rupee worth of asset collected. Now after 1 month, if you give the 100 rupee back, don't I have to give back 100 rupee worth of asset to you? Basic transaction, my dear. It's a basic transaction. You have taken 100 rupee note which is printed by me, but you also have given something to me worth 100. But if you give the 100 rupee back, should I not give you the asset back? Should I not give you the collateral back? Answer is yes. So that 100 rupee is referred to as liability of RBI. Right? So that is a basic technical concept. Right? Simply understand this. Simply understand its liability. Books don't discuss it, but this is why RBI says the currencies that have printed and distributed, it could be, let's say, even coins also. Although coins are of not very high value, either take coins or, let's say, currency notes. Focus on currency notes. These are counted as a liability of RBI. Okay. Now, M0 is referred to as base money or high powered money or monetary base. Let me ask you a very simple question. Simple question. If the M0 increases, can I say money supply in the economy also increases? I'll repeat it. If I say M0 increases, can I make a conclusion and say the money supply in the economy also increases? So how is that possible? Focus on the first component. Focus on the first component, currency in circulation. If RBI prints more currency, supplies more currency in the market, which means M0 has increased, don't you think the money supply in the economy also has increased? Right? Is the logic okay with you? Right? So if M0 increases, generally we say the money circulation in the economy also increases. And that is the precise reason this is referred to as high powered money. I hope you understand. That's a precise reason why this is referred to as high powered money, because it can increase the money supply in the economy very, very easily. How does it happen? We'll understand after the lunch break. Please don't worry. But please understand this. If M0 increases, generally it increases because of increase in the currency in circulation. As a result of this, the overall money supply in the economy automatically goes up. And that is the precise reason this is called as a base money, called as a high powered money, or it is also referred to as monetary base. Right? So we'll just take a pause here. After the lunch break, we'll start from here. Is it okay? After the lunch break, we'll start from here. What is M1? What is M2? What is M3? What is M4? We'll understand it after the lunch break. Okay. Now, before I take the lunch break, let me start addressing your questions one by one. If you have any questions, please do let me know. Now, one of the question regarding corporate taxation, right? There was a question regarding corporate taxation. The question was, already government expenditure is more than the revenue, but in recent budget, they announced to reduce the corporate tax from 30% to 22%. Don't this cause India under economic burden? Then it may be hard to introduce new schemes. How do government manage it? There are various reasons for this. One, when we were discussing the concept of corporate taxation, I've already told you the government has reduced the corporate taxation basically in order to attract investment, in order to phase out exemption under the corporate taxation, etc. But you're right when you say, sir, if they reduce, will they collect a lower amount of taxes? Of course, yes. And I've told you this yesterday also. The government itself, please check it in the website if you want to check it. Government minister itself in the parliament has announced that the amount of tax revenue foregone because of lower corporate taxation is more than 2 lakh crore rupees. But the objective is not that of a loss of revenue. The objective is they want to phase out tax exemptions. Right? That is one. And second one, if they want to spend more money, they will simply borrow more and more from the market. That is exactly what the government of India has been doing. Okay. Money in circulation, right? We'll understand it after the lunch break. There is a term called as currency in circulation. Currency in circulation, or nothing but money in circulation, generally includes 2 points, right, or 2 components. One, the cash that is there with the public plus deposits that is there in the banking sector. That is generally counted as currency in circulation. Okay. SDF, standing deposit facility. I'll repeat it again. Standing deposit facility simply refers to the rate of interest that is charged by the banks when they keep deposits with RBI. That is standing deposit facility. What is bankers deposit? Bankers deposits such as, let's say, CRR. Banks keep deposits with RBI, which is nothing but the liability of RBI, that is bankers deposit. RBI not give currency to banks to circulate in market by taking bonds from banks. Generally, the objective is simple. RBI, when they give money, they will collect a certain collateral or asset on the other side. That is the reason whatever money is issued, right? If basically it's a accounting concept. And again, I don't want to use that term because for UPSC 1 it is not required. Only for commerce background student they will be able to understand it. Generally, whenever RBI prints and issues currency, right, they will collect some collateral and they will have to enter this in the accounting books. That is basically called as a balance sheet. And whatever assets they have collected as collateral, they'll put it on the asset side, and the currency that they've issued, they'll put it on the liability side. That is basically the accounting concept related to RBI. Okay, done. Let's take a break then. Let's take a break. So, let's take a break now, 1 o'clock. Right, so we'll start the session at 2 p.m. We'll start the session at 2 p.m. Right, we'll start the discussion 2 p.m. We'll take the lunch break for 1 hour. Okay, so see you on the other side. Let's start the session again at 2 p.m. Bye.